having an affair or they're just very shy. I'm not quite sure. Yeah. Oh, look at these two. All right, come on. You're okay? Oh, what? Either they're having an affair or they're just very shy. I'm not quite sure. Yeah. Oh, look at these two. All right, come on. You're okay? Oh, what? Either they're having an affair or they're just very shy. I'm not quite sure. look at these two. All right, come on. You're okay? Oh, what? Either they're having an affair or they're just very shy. I'm not quite sure.
Good morning, everybody. How are we doing? Now, good morning, Mr. Beecham.
You shouldn't take the mick out of people. It's so cruel, isn't it?
Isn't it so cruel? Because it's so undeserved. Welcome to Trade Live with IG. It is a very dreich Monday morning, Mr. Beecham.
You would have a word for that, wouldn't you? Yes.
It is, yeah, that is the perfect
word.
Scottish term, really, isn't it?
Really, yes. Yes.
So, how are we doing? Monday, the 21st of July.
21st of July, yes. Yeah.
Top of the market. I mean, top of the morning, sorry.
Top of the morning, nearly top of the market. It's not far off, are they? Yeah. How was your weekend?
It was uneventful.
Oh.
Because I got Pete warded on Friday. So we went out to a client lunch and it was wonderful. Very good morning to the clients if they're tuning in this morning. Because
Where did you go?
A couple of them. Do you know my favourite reaction from clients?
Can you say that on air?
IG's got a TV show.
Yeah, exactly. Yeah.
What's the PCM doing? Why don't the clients know that we've got a show?
Well, it takes time to get this thing in. You have to repeat this stuff over and over again.
Yeah, very true. So, so he was very excited to find out we've got a show. So, good morning, sir. Won't say their names. It's always unfair, isn't it?
Don't say their names, but get them watching, get them subscribing.
But I had a very easy cut at 4:30. We finished lunch.
Where were you? Which lunch were you?
Clap in Knightsbridge.
Oh, right.
Great restaurant, actually.
Yeah?
Beautiful. It's got a roof terrace, so you're looking at the whole of Knightsbridge.
And it's around the corner for you, really, so you can just stagger home.
I could easily have. That was my bum, but they convinced me to come with them into basically Shepherd's Market.
Right.
And then we got a drink there, and next thing it's 9 p.m. It was awful.
One thing led to another. Yeah.
Well, there was a large Australian wedding group having their wedding reception there.
Right.
So yeah, it got a lot of fun.
Gosh. So you didn't surface till what, midday on Saturday or something?
No, still get up early.
Oh, okay.
But yeah, had a bit of a headache. What about yourself?
We had a lovely weekend. We saw friends yesterday. School friends. We're still getting together, so it was nice.
Oh my goodness.
So it's a bit of a. It's odd because we were going to go down to the park and just have time. Of course, it rained, didn't it? And so we ended up going to one of our friends' parents' houses. So we almost regressed about 25 years, really.
No way.
Yeah, but it was very pleasant just for a couple of hours or so. So that was nice. And then we had a friend of ours was giving a recital on Saturday, so we went and did that. And actually had some time away from the children, which is pleasant.
How old are they?
Well, the oldest one's 14, but he can look after the youngest one, so that's good.
Oh, perfect.
You can leave them, put the youngest one to bed, go, and then you can. So it's just quite nice, really. It's finally providing some return on investment, if you like, really.
Has he got his demo account up and running? Right, what have we got coming up on today's show then? Good morning, everybody. How are we all doing? We got, Beachy through with us till 8:30, sorry. And then Angeline has Martin Harris in live from the trade desk.
That's African Warren Buffett, isn't he? Nice, wind him up like that.
What, he is Warren Buffett?
Yeah, he likes Warren Buffett.
The South African Warren Buffett.
He's a sensible one, yeah.
And then, all sessions we've got, 9 a.m. will bring you those opening prices. Not too much over the weekend. The futures are pretty dull. But technically speaking, Chris Beecham taking Axel Rudolph's place.
Yeah, he's gone off on holiday, so you've got me for a little while.
Now, where is he? Because he's away for a few weeks.
Turkey. 3 weeks he's away. Lucky so.
Does not mind. Does not mind.
No. It's fun.
But I'm never sure about that. And that's, and then we've got Garth McKenzie coming up at 9:35. I'm never sure about taking all your holidays at once. I'm much more of I'll take 2 days there, as I am this week. Thursday, Friday.
Where are you off to?
It's Ibiza time.
Oh, gosh.
So it's a bit of a reunion of our group as well. So we've known each other, 20 years now. Wow. And we all started on the Credit Suisse well, some on the graduate scheme at Credit Suisse, and then there's an American kid that I did my German Zitra exam with in 2005, and he was sitting next to me, and he had no clue because he was just fresh off the boat from Boston.
Right.
And so I had to help him, and he still failed.
Well, you were a good teacher then, weren't you? Well done.
So Kobe and I became very good friends, and he then went on to work for Goldman's for about 10 years. So real smart kid, but he was at Bear Stearns when Bear Stearns collapsed.
Does he? Gosh.
Yeah. So we're off on Thursday evening. So I'm only taking Friday off and Monday.
It'll be fun.
Ibiza.
Nice time.
Yeah.
Is it really hot out there still, or is it cooled down a bit?
No idea. I can't even look at the weather forecast here. Never mind over there, because I clearly missed the umbrella shout this morning.
Well, at Mansion House, it was raining.
Yeah. This morning, but also remember your umbrellas for this market, because it's about to get cloudy.
Why? Oh, because it's
Clouds
alphabet.
are on the horizon.
I see. Are they? What are they?
Well, you're going to find out in overnight action.
Shh, come on then.
That's right, Bank of America coming out this morning and saying that all of their key proprietary sell signals have been hit. Flashing red.
Oh, spare me. What's this side? What's this then? Where's you seen this? Where's the headline?
Oh, this is research. So they've got sort of these measures around breadth, and let's see exactly what he is saying here.
Is this the sentiment survey from last week, or is this something else?
No, this is their proprietary. So fund managers cash rule. Cash as a percentage of their AUM.
That's down to 3.9%, isn't it? So that's below
Correct.
The
The average SPX return post this signal over 15 cases since 2011 is a fall of 2%.
2%?
The global breadth rule, 64% of MSCI indices above their 50 and 200-day moving averages, below 88% sell signal threshold, and then the global flow trading rule, and that's below 1% of AUM.
So they're
sell signal.
So they're saying, what are they saying for the next 10, 15 days? What's the expectation?
5% pullback.
Oh, shock horror! After what? How much are we up?
Believe me, if we get a 5% pullback, that is everything, because my call options that I'm short of, I think an average strike of about 6,300.
20% gain since the April low. 5% is the best the bears can get. Is that what's going to be?
Well, I mean, that is actually part of the argument as well. So, let me
what's that?
Let me take a second to get the graphs up, and you run us through what you've seen of BP this morning.
So BP, new chairman Albert Manifold, which is an interesting surname. Headlines write themselves, to replace Helge Lund on the 1st of October, was what I saw in the headline.
Yeah.
Where he comes from CRH, wasn't it, the building firm?
Yeah, which is a little bit random.
Yes.
CEO of CRH for
Going
14 years.
New approach. No bricks, just oil this time. So. Well, I suppose maybe that's what BP wants. It's someone who's out the industry who can take a fresh approach. I suppose that's the logic behind it, really. I wonder who else was interviewed. Interesting to know.
To be fair, he's been very impressive. The CRH share price is up, I don't know, 130% in the last 5 years. But still, I'm not sure if it's quite what the market was expecting.
No. Yes, because they reshaped the portfolio at CRH and delivered superior returns, so that's why they've picked him, I suppose. Be interesting for a company that really needs a firm hand on the tiller, a proper direction, because obviously the predators are now circling.
Yeah.
Aren't they? Shell has opened the bidding on this, and others will think.
Allegedly.
Well, yes. We may or may not have had conversations that may or may not have had another conversation.
But we won't have those conversations won't come to a conclusion within the next 6 months. So we'll deny it.
We've voluntarily ruled ourselves out, unless BP were to come and ask us.
Yeah.
Please save us from the Americans would be the possibility, I suppose. But yeah, that's interesting.
Right, let's look at these charts then. What are the charts that are proving particularly worrying to everybody out there? Well, that's your most shorted basket. That's up 83% from April the 9th. That's against a NASDAQ of only up 35% since April the 9th. And then what about seasonality? Well, we are right there because you've got, there we go.
Probably a bit further along, but yeah, roughly in that region.
Yeah, we are right on the flat line. So flat line for up to 3 months. And that is partially because the buybacks are going into blackout period as well. So there's not that huge support every day from the companies buying back their own stock.
And if you got the cash chart there from the fund manager survey, have you got that one?
No.
Let me just try and find it. So that's, for those who are not familiar, the Bank of America do this monthly survey of fund managers, and they say, what are you overweight? What are you underweight? What's your outlook for the next 6 months? Do you think it's going to get better? Do you think it's going to get worse? What do you think is all these kind of things? And the one they ask is, what's your cash level? And usually when it's over 5%, it's what they call a contrarian buy signal, because it shows you that fund managers, which have to stay invested most of the time anyway, have been freeing up firepower for a better opportunity.
Yeah.
And so we saw it hit 5% in April and May, and it's been dropping since then.
And that's now 3.9.
Yeah. And that's not an automatic sell signal, because it could simply mean that the money's been put back to work and you can see further momentum. But they are.
It does mean everybody's in.
It does mean that everyone's more in than they were. Certainly, I think is the way to look at it.
Yeah.
And that you could possibly see maybe some of the rampant bounce back we've seen could slow down.
Well, there's certainly slowed down in Netflix on Friday. So the start of tech reporting season, down 5%. That's your first one. Is everything in the price? Well, clearly it was in Netflix. Then Exxon down 3.5%. We had Amex was weak. United Health was weak. Broadcom gave up 1%. And then the winners, winner chicken on the upside. Tesla up 3%, up to 330. What a bounce back.
Interesting.
They just don't care, do they?
No. And Netflix move is interesting because the average move after the last 8 results on the day after has been a move up of 6%.
Yeah.
So it is interesting that you've seen some weakness creep in. But then, of course, the Netflix share price is up, doubled in a year, isn't it? It had doubled into earnings. So now we're in up
Doubled
to
and down 50%.
86%. So, and it had a bit of a drop in April, but weathered the storm relatively well. So I think after that kind of doubling of the share price, it's probably not surprising just to see people go, well, okay, you increased all your subscribers. What was the really good news? So it's just a bit of caution coming in there.
Right, and then let's have a look at where those futures are this morning. Before we go into that Japanese election result, we've got up 25 basis points now. It's creeping higher, the S&P. That would be a new all-time high. The NASDAQ 23,000. The FTSE unchanged, and then Europe's getting ready for a battle with Howard Lutnick and the US tariffs. So we've got the DAX down 10 basis points, Vol down 0.5%, gold up 50 basis points, and Bitcoin now rallying after I got stopped out at 11 p.m. last night. Brilliant.
Such is life.
Absolutely. They went hunting for my stop, I think.
Don't say that. You don't spread that kind of calumny on this program, please.
Oh, they definitely go hunting for stops in Bitcoin. So when I say they, I'm not talking about IG. I'm talking about...
Don't fuel the conspiracy theories.
Oh, yeah. So we used to do it all the time.
You're not really not helping this now, are you? You're just feeling...
Of course you go hunting for stops.
Yeah, right.
That's how you get people out of their positions.
Can we cut this bit out? Can we cut this bit? Can we mute him?
That's market making. Right, copper up 30 basis points to 564. And then iron ore, look at that. Rio's going to be up this morning to make up for my losses on Bitcoin. So yeah, iron ore is strong. That is new highs for the move. So expect Anglos, Rios, BHP all to be strong this morning.
So this Japanese election.
Yeah, go on.
The they lost some seats. I mean, this is one of those moments where I have to be a macro tourist. I'm literally boning up on Japanese politics on the way in to sound slightly
Intellectual.
knowledgeable on this front. But yeah, so he's suffered a bit of a loss, but he's not going anywhere, which is really interesting because, of course, the problem for Japan is that Abe and Trump really got on. Shinzo Abe, the Prime Minister and Trump's person, they both love golf. They were best buds, and every time Trump decided to go off on one about Japan, Shinzo would ring him up and say, "Look, don't be. Can we come and have a chat?" And they'd smooth it over. Japan doesn't have that. It doesn't have someone that can go golfing with Trump and nobble him about tariffs and whatever he's annoyed about this week. So it has been a real problem.
And that is the way Trump works, 100%.
Yes, which is a problem because, of course, he's coming here this week and he's playing golf in Scotland. And already number 10 has firmly said, no, there's no chance of Keir playing golf with Trump. They don't want the shots of Keir and Trump playing because they know it won't play well with a lot of voters. But it is, as you say, that's how he does deals.
There's no way Starmer can play golf.
No, I don't think he even has ever tried. So that would also be a disaster, really.
Right, what's happened to markets over in Japan?
Well, it's a holiday today in Japan as well.
Is that what it is?
Immense number of national holidays. I wonder what it is today.
So that is the longer term one. So that's going back to, well, about 12 months. And you can see what happened there. Oh no, it has it's crept back up, and it's
Marine Day in Japan.
Marine Day.
Celebrate the ocean and its bounty. So there you go, it's a national holiday for that. But yes, Nikkei doing well. Of course, the yen's been a bit of a winner the last few days, hasn't it? Because of it. So you've seen the Nikkei take a bit of a knock just off those highs. We're nearly at 41,000.
It was 147. Yeah. So yeah. Over the weekend there, we saw it trade around here on Thursday, I think.
Yeah. Muted reaction at best.
Yeah. There we go. Yeah. Okay. Moving on, we've got numbers from Stellantis, Chris. Now, we saw Renault profit warning last week. I don't think it's looking much better for Stellantis. We had, to see if we've got the blurb there. Here we go. Now, the stock is down 57% in the last 12 months, but that's because they are, their sales in US are down 25%. Their shipments this time, I think this is H1, were down 6%, 1.4 million vehicles. And it's a lot of vehicles, actually, 1.4 million, isn't it? Revenues 74.3 billion, but their H1 loss was negative 2.3 billion. Why are they making a loss?
Inflation, tariffs?
I don't think there's any tariffs on
cars. I don't know where we are.
H1. But just why are these companies so bad?
Legacy, isn't it? Sorry, I'm just trying to get back into my internet. It's locked me out. So.
European automakers, it's just another one in the long run. So we'll look for a pre-market on Stellantis for you, but no respite there. No, certainly doesn't look better than Renault was.
Very miserable.
Yeah, but what does look better is Ryanair. Ryanair looking better than EasyJet results last week with their numbers out this morning. I think record profits yet again.
Yet again, another strong performance. Sorry, my internet's finally coming back. So what did we get? What numbers did we get?
And, there we go. Q1, 820 million versus 716 poll forecast. That's how you make a profit. Sees its agreement with online agents hitting rivals. So much better than EasyJet by the looks.
Yeah, very, very strong. So how have they performed versus EasyJet in share price terms?
Well, we were talking about this week. The stock is just an absolute performer. Absolutely incredible versus EasyJet.
Right.
New all-time highs. So
stellar performance. Sorry, let me try and pull it up.
So more profit, more than doubling on its April to June quarter. That was the same thanks to Easter holidays, but I think EasyJet had those as well. And then bookings,
interesting, isn't it?
Bookings for the rest of the summer are robust. So yeah, let's see what we get as a pre-market there on Ryanair. Looks like we're getting some early indications. BP are looking unchanged. I think that's perhaps somebody just wonder what.
Nothing to say. Precious
Such
did in
a
a
hit.
statement. Yeah, Ryanair's left easier far behind, isn't it?
Yeah.
Huge returns.
Oh, completely two different
over the
industries,
last
you
year.
think.
Yeah, exactly. Dear.
Right, Angeline very kindly putting upgrades and downgrades up. BAT, the target price raised at Deutsche. We don't know from what to what though, so let's see if Ange can get those details. GSK, Morgan Stanley have cut their target price, and Unilever, Barclays have cut their target price as well. But that doesn't mean much unless we've got figures, because it could be from
1p down.
1p to 2p. Right, let's see what we've got in commodity world then. Ahead of this big open on Monday, the 21st of July, we've got oil looking gold we talked about earlier. That's a good one. Platinum rallying yet again. Platinum up 70 basis points. Is that 1,440? Is that a new high? Let's have a quick look at that.
Ooh. We talked about it last week, didn't we? That was a mover last week. No, because last Friday it was 1470. So when Friday's high was.
So there we go. It's 14. You're right, 1470. But certainly find support down at 1,350 when it tried to drop there back in mid-July. But this has been an incredible run.
Yeah. As we said last week, it may be partly a reflection of just other money coming out of gold or other stuff looking for precious metals and semi-precious and just the flows as well. So, yeah. 1483 was the high from Friday session, so we're not far off.
Would you imagine it go back into gold now?
Maybe. It's just that kind of diversification, isn't it? Try and get a bit reduced exposure to gold. Gold's having a cracking morning, isn't it? Up 33.70.
Yeah.
So the highs for the last week or so have been right at 33.70. So this could be another push.
I think I'm actually going to buy some gold here with a bit of a stop, because it's something that I want to be involved in.
Very constructive price action. If you see those higher lows coming through for the end of June at 32.50, then again at 3300, and then last week at about 33.20. Overall, what you want to see, I think, if you expect it to keep going.
Yes. So I'm buying £10 a point with a $20 stop. So that'll take it Actually, let's lower that a little bit more. So 33.44 stop, 33.42 stop, and £10 a point buying gold at 3369.
There we are. On what is it's a busy week, but it's not a really busy start to the week, is it? Has to be said. We've got enough going on.
I think that could be we do. Did you read the Times this morning? Let's have a little.
Let's look at the front page.
The front page of the business section on the Times there. It's all about UK house prices. I think there's three articles this morning on how gloomy it is, not just outside, but in the housing price.
Now, is that a contrarianly bullish signal if everyone's full of doom and gloom? I don't know.
No, I don't think so, because it makes sense, right? Doesn't it?
I suppose so.
Expectations were for a 4% rise in house prices, and they've take that back to up 2%. But then also the London rental market, we see this down here on the right-hand side. London rental growth slows as mortgage rates fall, and the expectations were up 4% rentals, and now they only expect up 1%. I think I might have to give my landlord a little call there, because I've got this agreement that it goes up with inflation.
Right.
So what, inflation is 3.6?
Yeah, last week.
Yeah. I had to print off
You
that
must
article.
have, so you did really well in sort of 2009 onwards, didn't you? And then must have been hell in
Oh God,
2022.
I've had about 8 houses since then.
Yeah.
Rental. Never bought a house in my life. I had one opportunity.
Right.
There was a 3-month period in 2009 when I could have stepped in
And why didn't you?
and got something. Because the one that I wanted was owned by the Wellcome Trust. So they weren't sellers.
Right.
Because I'd lived in it for 5 years.
Right.
I did bid them.
Bid wasn't welcome.
Right, is it time for our chart of the week, Chris Beecham?
I think it is. What have we got?
First chart of the week is a US stock. We've got the usual crew on this morning. Who is going to... I'm confident in Steve Davies this morning. Steve Davies, I want you to take a look at this one. I think you've got this. Good morning to Stuart Wallace. Stuart Wallace asking for NVIDIA predictions. We are going to look at that in Fast Markets coming up in about 20 minutes time. And yeah, RSX Senna, do you reckon you're going to have a go at this chart? US stock?
US stock. Okay. No clues yet.
3, 2, 1, go. Oh, wait, do we know it?
Yeah.
I still don't know it.
No?
What was it?
One of them's got it. Gavin's got it. It is the Spotify.
Ah, that's why you put spot. Right. I thought he was looking at spot gold or something.
No.
Spotify, is that what it was? I would never have got that. Well done, Gavin Ackers. Superb. And also Blue Elegy as well. Blue Elegy backed that up there. But here we go. We're off and running. Right. So as we said, the miners are going to be strong this morning from that iron ore price. If you mine iron ore, you're up and away. Bats up 47 basis points. Angeline very kindly wrote us out the price targets. Deutsche have raised them to a price target of £42 from £38. So Deutsche, I don't know what they're smoking, but they think Bats is going higher. GlaxoSmithKline, Morgan Stanley cut to £12.90 target from £13.55. Pharmaceuticals? Must be pharmaceuticals.
Must be a bit weakness in there. Yeah.
But we're seeing WH Smith up 2%, ITV up 2%, BHP up 1.5%, EasyJet rallying on the back of Ryanair numbers up 1.7%. That was a good purchase for somebody at 485 last week.
Very good, yeah, very good.
And then what about the losers of the day, Beachy?
So we have Flutter on the back foot, down nearly 2.3%. Travis Perkins being deconstructed at 1.7%.
Maybe somebody took a bet that there was no way that the women could miss 10 penalties in a penalty shootout.
That's gone over my head. Was there a women's game on?
There were, England last week, there was a penalty shootout, and literally, I think they only scored 2.
Was that Thursday evening?
Yeah, Wednesday or Thursday. Yeah.
Oh, of course, I was in the pub. I think someone was watching it then. Yeah.
So, yeah, I don't think it's ever been done before. BAE Systems down 72 basis points, coming off the highs. And Reckitt's not really responding to those that sale of the business last week.
No, not doing very well. Have they got numbers this week? I think they have got numbers this week.
Well, we'll come to you in 10 minutes for Chris's preview of the week ahead with all those numbers. And yeah, we've got, have we had BP yet?
Haven't seen it. I can't think it's going to be the most earth-shattering news in the world, is it? With all due respect to the new chairman. And his manifold benefits.
It's flat, you're absolutely right. Right, Antofagasta up 1.6. Where is Rios? If Rios isn't up, I'm going to...
It looks like a fairly solid start to the session for broad-based moves higher, so that's not bad, is it?
Why is Rios not coming up on my... Phil said 2. There it is.
There it is.
Oh, there it is now. Right, so up 2 on Rio Tinto at last. At last, it should have been there last week. Glencore also up 2.4. That doesn't make sense. Glencore hardly any exposure to iron ore, and it's up more than Rio's. That I've got to trade on that. So I'm going to sell 5,000 Glencore and buy more Rio's, because that should be at least 50 basis points the other way. But that's just a wee trade, just a wee trade. Anglo's up 2%. New highs, 22.75. Good. That is making back some of the...
Gosh, that's good. I've had Anglos for about 10 years. I bought them early 2016.
Right.
And hang on to them since.
Oh, well, you might have some of that Volterra now as well.
Oh, yeah, I might do. I haven't checked my SIP for ages. I just let it sit in the background. I know it makes you scream, but it's very well, you just ride out. I mean, nobody noticed volatility, did they?
You need to be on that new pensions commission.
Yes.
Did you see the news this morning? So they're bringing back the pensions commission because they're worried that 34%, I think it was, of UK citizens do not put anything into their pension.
Scary thought. Very scary thought.
Right, Ryanair is open. Let's see how that is doing. It's up 8%. My goodness me.
Gosh.
Wow. And it's still going. Up 10.
10%. Gosh, it only moves. Wowzers.
That, I guess it must have gone down on the back of EasyJet's poor results. But that spread has really blown out now. Air France following it up 1.5, Lufthansa up 1.4, and but yeah, really strong numbers from Ryanair this morning. Only up 7. The 10 seemed a bit much. That's lively, isn't it?
Bullish start to the
Up 10 to up 7. Right, what have we got down there? Stellantis, airlines over autos, down yet another 3%. That is now 60%. In 12 months, Stellantis has fallen. Value destruction. Volkswagen sub 90 euros. Mercedes-Benz heading towards 50. BMW sub 83.
If it was to be up 20%, sorry, 10% today, that would be one of the top 20 daily moves in Ryanair in its history, or at least since 2000. So there you go.
Right, let's take a look at Renault. Renault, remember we were talking about this at 35 euros, which is where it opened after numbers. Now 33.50. So not only did it drop, but it's, I mean, I don't know about charts, but that doesn't look pretty.
It doesn't scream healthiness, does it, really?
No.
Poor old Renault. European car makers just in the worst place, aren't they, really, I think? Just getting squeezed.
Yeah, from the Chinese especially, seeing that they're seeing real competition. I don't think Chinese competition in autos is going to go away.
No.
So maybe Renault have to do something about it.
It's going to be a big, big mountain to climb for them. I think very, very tough outlook there.
Right, let's see. Right, Anglo's kicking on, Glencore kicking on, and Rios. So yeah, there we go. It's 2.7 now. So they were all a buy on the open. BHP, small underperformer, bit slower, bit less punchy, but yeah, still tempted to buy some more Rios. No, stand back. But Antofagasta being up. What is, hang on, what is copper up? Right, copper is up 70 basis points this morning. Is that right? Wow. So let's just check that from the close of Friday. And we have Friday 4:30 p.m. Here it is. Sorry. Let's. What's happened there? Friday at 4. You're right there.
Apologise. Catch me out this morning.
Right, Friday at 4:30. Copper was trading at 462. It's now, sorry, 562. It's now 566. So it's up less than 1%. So why is a pure play copper stock up the same as an iron ore mining company when the two of them have vastly different?
I mean, it's always dangerous trying to rationalise a move, isn't it, really?
Well, it's not. It's because everybody trades sectors now.
Well,
right?
yeah,
so you
yeah.
don't trade individual stocks. So
there's no logic to the move, that particular move.
Right, I'm going to sell 700 Antos here, up 2.6. And
where's the stop?
Yeah, everything else is about right. Okay. Good. Right, now 8:08 this morning, we are seeing the air. EasyJet. I don't know about EasyJet because you'd be more worried why it's left behind so much.
So just struggling because it's very, very odd to see. I don't know. It's hard to rationalise. It's at 1.7% in early trading, so there is that. But it's essentially up 2.5% price since late 2020. So you've seen the share price go.
And with a cap raise in there as well.
Yeah, you've got 2.4% yield in there, so that's okay. But yeah, share price that is not much up from where it was 5 years ago. Not really about EasyJet.
Well, this is fun. On our upgrades and downgrades this morning from Anne's very kindly put them in the chat there. GSK is up more than BATS. And Glaxo's been downgraded and BATS has been upgraded. Just shows you the algos don't care in UK defensives. If that was Tesla against Meta, there would be a 5% differential, but no. They don't even bother, do they? SSE, my mother got her stock portfolio statement through.
Right.
And she was especially pleased because her SSE was back up.
Right.
That was on yesterday's call.
Well, they've done all right the last 5 years. I mean, yeah, it's quite a strong.
Not so much the last.
No,
but
not
I did remind her she also gets a
September.
dividend.
Yeah, exactly. So since it's been a bit of a choppy ride the last year or so, but moving in the right direction.
My final evidence for this being the top of the market I got so I've got a pension with St James's Place. And I received a letter from St James's Place. Now, where is... They wrote to me to warn me that more than a quarter of your retirement account is invested in the money market fund and has been for some time. This fund has underlying returns linked to short-term interest rates without the benefit of exposure to a wider range of assets. They're writing to me to tell me I need to invest that money and that taking 4.5% isn't enough.
No. That's interesting. Now, do they get
absolutely
that
nothing to do
periodically?
with them.
No, it's not their. Can they say that? I mean, it's interesting.
I mean, I assume that the regulator forces them to.
Why would the regulator force them to?
For example, £10,000 today in 10 years would only have the spending power of 8,200, assuming 0% interest. How can you assume 0% interest? It's in a fund that's getting paid 4%. What are they doing?
That's an odd letter to write. We've
St
not
James's Place, answer these questions.
Compound what, 4.6% a year by 10 years?
Yeah.
Cash returns, come on.
Yeah.
But I got to say, if you are interested in more chatter, more discussion around pensions and around how to set yourself up, around the returns, we've got 2 experts that have been doing this stuff for 40 years, running money for some of the UK's biggest pension funds, and that is in our new podcast. So The Art of Investing, the second episode, went out on Friday evening, and it's a beauty. We got over 1,000 listens so far, and yeah, it's well worth it. And there's some few jokes in there as well. The guys are great fun to work with, and yeah, you can find it on Spotify or Amazon or Apple or Audible. Or on the IG YouTube. So that is under The Art of Investing. Phil is very kindly going to put up the links for you. Right, it is 8:13. We're going to have a quick 2-minute break. We're going to come back with our fast market section, and we're going to go through previews of the numbers coming up this week. See you in 2.
See you later.
Okay, guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat, come on. Cash returns, come on. Oi! Well, you're not going to get better than cash returns.
Today we're here because we've recently launched our Save Our Stock Market campaign. We just want to raise awareness for terrible cash returns that everyone is getting with their money just sat in cash ISAs. What we want to do is raise awareness for the great returns that you can get on UK stocks and help revive the UK stock market and get people investing.
There's a lot of bad feeling about the UK stock market, and it's really negating people's view on the UK market as a whole. There's some great companies. If we just start the ball rolling on people getting behind the UK stock market, then we can start to get the interest. And it's days like this, we get awareness of all the crowds talking about stocks. It's really that awareness, and ideally we'd like to take it to the government. We would like cash ISAs to be reduced, not because we don't believe in the chance of people saving, but more that you get higher returns, as much as 7 times historically, in investing that you can from cash. And that's not saying people go out and take a load of risk. It's about education, and it's about helping people to understand the benefits of investing and the limitations of holding their money in cash. Right, welcome to Fast Markets. So we've got a load of companies reporting this week, both in the UK and the US. Probably, I'd say a bigger week in the UK, actually.
Yeah, it is. It's obviously US earnings season is in full flow. You only got 2 major names. Well, that's not fair, but the ones that people really, really care about.
Those being?
Tesla, of course, and a little company called Alphabet.
That little, yeah.
Yeah.
Right, so the main highlight of the week, of course, is Vodafone on Thursday.
Yes, of course, and sleepy old Vodafone.
But also on Thursday, you've got ITV, you've got VODs, you've got Lloyds, you've got Reckitt's, you've got Anglo American, and BT Group. And then that's backed up by NatWest on
Friday.
Friday.
If you're silver, it's Fresnello on Wednesday. So there's plenty going on there.
Yeah. Which one would you like to discuss first?
Do you want to do Vodafone?
Go on then. So
I don't have
VODs.
to talk because you just know everything. So
But yeah, but then they hit me with the sleepy,
yeah.
boring music.
I mean, I can't believe there's not a Vodafone segment on the weekly show yet.
It would have to be a really catchy tune, wouldn't it?
Yes.
I'm not sure putting that screen up, Dom.
That's perfect. Exactly. It encapsulates
there
everything.
you go. There's the Vodafone chart. Right, let's have a look at what we've seen the last few months since Margarita came out in the last set of or the trading update and said, we are done. That is our reorganization now complete. We're starting to look like the company that she would be proud to call hers, rather than what she inherited as CEO. So, are we seeing what is necessary in Germany yet? Probably not. So to really get this thing up towards and over 90 pence, you got to see the fruits of their labour come through in Germany, and I think it might just be a little bit too soon for that.
Do you expect it to be a little bit mixed after, because obviously it's had a fantastic run up? So.
That's the thing. If it was 75p, then I'd be very happy going into it.
Fill your boots, as they say, or whatever. No.
Yeah, no, I would be comfortable.
Comfortable.
I'm not as comfortable going in. I'm going to keep them, obviously, because why would you ever sell your kingmaker?
Of course, yeah, inevitably. Why would you do such a thing?
But I'm short puts in the 6 days, I've taken the vast majority of that, but I'm also short puts now 76 pence, and then long stock in the ISA as well. If they hold the ATP level this week, that would be encouraging. I'll be happy. Yeah. Still going gangbusters in Turkey, in Africa, and in Egypt as well. So there are benefits, but UK integration still months off. A turnaround in Germany still months off. See, I told you could just talk for England on Vodafone. Go on then. What's your choice? No, well, we've got the banks, of course, as well. So Lloyds and then NatWest are very important to watch that. Lloyds crucial, solid lending volumes expected, and they're relatively positive on its core mortgage, because Lloyds is what. How much of the mortgage market is massive, isn't it? It's an absolutely huge player, so key. Which is interesting, of course, in light of those comments this morning in the Times about house prices. Mm-hmm. So that's the key thing to watch. Watch anything. I think, did they get anything with this motor mis-selling probe? Is that going to affect them? When do we get the actual result? I don't know on that. Very, very much there. Lloyd's front and centre there. Yeah. NatWest seemed to get away with it. Yes, and of course they recently bought Sainsbury's Bank, so they've got a bit more of a scale on the consumer front. Mm-hmm. And then watching for any updates on net interest margins as ever from the ECC, really. And banks, obviously, like US banks, you get that overview of the economy, you get a sense of, what they call it, the commanding heights of the economy. Yeah. Really, how it's faring. So that's always a good one for an extra bit of read after what has been a very gloomy
Because the GDP last week, wasn't it, for the UK? Poor.
Underwhelming.
Underwhelming, yes. Poor old Rachel Reeves.
I watched a postcode podcast at the weekend that asked, what is the most important sector to the market?
Globally or to the UK?
US.
Okay, well, tech. It's got to be.
Apparently not. Apparently financials.
Really?
And this is a guy who has been in doing it for 25 years. He says that absolutely if you want to know the underlying feel of everything,
Look at the banks.
look at the banks. Yeah. So let's see how those will be doing it. XLF, of course, because you've got that higher for longer.
Yeah.
As well, because you've got the IPO market coming back potentially, then you see it is very strong. Charts are not playing ball this morning at all. What does that tell you?
That everything
That's
is
post-reporting season.
Yeah. But US banks have absolutely crushed it. They have done so well over the last 5 years.
Absolutely. But interesting, in reporting week, unchanged. Does that matter?
The numbers were okay, weren't they? So I think we should read that into it. What's the seasonality in XLF, I wonder? How does that look? Probably a bit of a...
You'd want to see that making new highs, wouldn't you, if you were going to see the market kick on?
Well, I think there's a very stable candle to start to finish off the week, really, isn't it? So that's the fact you've got a recovery. In fact, 2 good candles, that Thursday one, the recovery, and then Friday.
Yeah, that would have been
a decent follow through in terms of price action there. So you puts it in a much better form to challenge those recent highs this week and see really how stuff goes. Don't forget, of course, it was the will they, won't they last week with Powell.
Would you rather be in US banks or UK banks?
Oh, US banks. US banks.
Not for the long term, but
for
the next 3 months.
Even so. Might not want to be in either, to be honest. In the next 3
Well,
months.
that's interesting.
Just a little bit. If you're buying it now, I think you'd just be a little bit cautious, I think. But you definitely want to keep the banks on the watch list.
And then we look at Lloyd's as well. Lloyd's just absolutely primed and ready for a breakout, but big set of numbers actually.
Yeah. Could be enough just to get a little bit of a caution coming in.
Well, I mean, if you go with the Bank of England and the
they want to cut rates, of course, don't they? So they're very keen on talking about cutting rates again. So
yeah, but general sentiment on the UK economy, you wouldn't think it deserves to break out.
No.
So
contrarian, therefore must break out because everyone's so gloomy. It therefore is going to defy everybody. Of course, Lloyd's always one of our most popular. Absolutely, everyone loves Lloyd's.
Speaking about popular, Tesla. So numbers.
We haven't done NVIDIA yet. We had a request from NVIDIA though. Didn't
Yes, we did. Okay, right. So we will go through NVIDIA. Of course, not reporting this week. Doesn't report till the 27th of August.
Yeah, right at the back end of earnings season for some reason. It's got to be different.
And let's have a look. So 172. Let's hear your view first, Chris, because you're just going to boo off mine.
Well, clearly it is now eye-wateringly expensive again. And I think that does put it in a bit of a danger zone. If you look at the chart, momentum it's just been an absolute train. If you stand in front of this, you get run over. That's been the problem for bears. The momentum readings are also high. Now, as Bloomberg likes to say, it's been overbought, but this is overbought as in, no, it's just going to step on you if you try and short it.
Yeah.
So the madness is there. The news flow has been very positive. I mean, it's gone from doom and gloom to restoring optimism, and the fact that they're allowing them to sell to China again last week gave it that extra nudge higher. So there's a really impressive story there.
Impressive story.
But does it live up to the hype? The problem is it going to see the same thing as we've had with Netflix last week, which is, okay, numbers are okay, but you've up so much, it needs a bit of a breather.
Well, but it's more, so I imagine the question is related around the other companies' comments on AI. We know Tesla will carry on spending no matter what, so that's going to be positive.
But other people are going to start reining in their spending because That's the concern. You've poured all this money into AI. Where's the return?
You need incremental, don't you? 172. So on the $5 EPS for 2026, this thing is on 34.4 times earnings. It is, of course, as we know, over $4 trillion. I'm short the 170 calls. I'm short the 177 calls. I think that is just an absolutely solid trade.
You've got to, I think it's still one to keep on the watch list. Remember, NVIDIA at $4 trillion, it's nearly twice the size of the FTSE 100. And they're talking about this in terms of weightings. It's now bigger than Japan in the all-country world index weighting. And it's nearly the size of Germany and France combined in its weighting.
I would expect that we look back in 12 months and NVIDIA's trading 175.
Yeah. Because
that's what happens, right? That's what happened. Screen on, thanks, Dom. That's what happened back here in June 2024, right? You see June 2024, if we go forward, 12 months later, we're trading at exactly the same, 9 months later, we're trading at exactly the same level. And that's what we have to do again.
Yeah.
We have to just give it some breathing space. So let's come back in 9 months' time, and I would have a very strong wager that this thing is at 175. Now, it can trade 200 in the meantime.
In the meantime, yes. Because this, if you look at, obviously, that chart, you went to 150. So I don't disagree with that view at all. I think you could, if you want to buy it now, fair enough. But be prepared to sit there for a while and watch it do a whole lot of nothing. But the problem is, if it comes off 15%, 20%, are you going to have the guts to buy? Is somebody else going to have the guts to buy it? That's the thing. If you go, I like NVIDIA, I don't like it up here.
So I cannot bring myself to short. So normally what I do when I'm short calls and it goes through my strike, I would then sell a put. I cannot bring myself to sell a put anything above 145.
No.
I'd buy them at 145. I can't. But we're talking about what, 20% there?
Yeah.
Not quite. 17.
But that's the key thing. If you like NVIDIA and you think, oh, I would like to buy it after a decent pullback, and the decent pullback arrives, then your brain says, well, don't buy it now because it might keep going. You've got to remember this moment and say, well, I put NVIDIA on my watch list just for this kind of moment to buy it after the pullback.
Yeah.
Otherwise, you're going to go, oh, no, I missed it again. So.
Away from the numbers, looking at Roblox. Oh, that's an interesting one. Do you look at Roblox at all? Your kids must be...
No, I don't think they are now. I don't think it...
Oh, my goodness. You're not kidding. Good spot, Neil. That is a beast.
Is that nearly not tripled, but not too far off that? Wow. 200% in a year to date, doubled.
This is one of those kind of obvious things, I guess, isn't it? Is we're talking right here. It's the kids game, yeah. So that's the kind of thing that your kids harp on at you. Like, can you buy me more tokens, buy me more tokens? And you should just think to yourself.
Yeah, buy the stock as well.
Yeah.
Imagine if you said to them, I won't buy you any more tokens, but I bought you Roblox instead. I bought you the stock.
I tell you one that we've never covered on here, and I've never heard anybody talking about. Go on, fill in for a second for me, Chris, while I find this.
Oh, well, this is the thing. It's a case of buying what you know. And if you're being hammered with this kind of advertising or subliminal or, children pulling at your trousers to make you do stuff, that's a sign, really, that you've got it's a very strong business model. Hype there.
This one. Right. Let me see if this means anything to anybody. PopMart International. Why do I have a chart up of PopMart after talking about kids' toys? Oh my goodness, we missed this. We absolutely missed this. Look at that. So...
Oh, it's these things.
These things. So these are the manufacturers of Labubu dolls, which have been all the craze. and people queuing up for hours just to get one of these dolls. And this thing has gone from
They are
$80 to $240. One of the, if you're at the absolute forefront, Tony Battista of Tasty, when he was across in London, took 6 of these home to people in America because it was so hard to get them across there.
Right. They're ugly things, aren't they?
Yours. I mean, it's a short ear, isn't it? This is
Probably, yes. What happens when that craze disappears like they all do?
yeah.
The next one comes along.
What hasn't? What craze has then lasted?
Oh,
Because one of the clients that was there on
iPhones.
Friday.
iPhones, I don't know.
Yeah, I don't know if it was.
Famously, there's an article from about 2007 that said the iPhone will not amount to very much and it'll be a failure. And I drag it every time I see the journalist's name, and I won't name him, but I do remind myself of that, and occasionally I reread it because it's entertaining.
I thought Crocs was a craze.
Oh, they're awful things, aren't they?
Yeah, so I definitely would have been short Crocs, even, down at 80. Well, I guess you haven't really. If you have these things against an index or hedged in some way, but yeah, always look for the new craze, I guess, because this thing's vastly underperformed.
But there's the kind of stock you don't marry, if you will. You don't stick with it permanently.
Yeah, let's keep an eye on Pop Mart. I think $240. But yeah, sorry, I was going to show you a picture. What's he talking about? What's this Labubu doll that everybody is obsessed with?
Producer Phil must have them. He's probably a big fan. So.
I reckon Angeline will have got them for.
Good Lord, look at them. They're awful.
This could have made us absolute bonkers money. Up 300% on the year. It's such a Japanese thing, isn't it?
Is it? Oh, it's Chinese.
Oh, the Chinese?
Yeah.
But it's, you see the people that are queuing up for this thing. Huge fans.
Well, there you go. There's no accounting for taste, is there? That grey one's hideous. Look at that thing. What on earth? You wake up in the morning and see that stuff.
That grey one reminds me of Ronnie. Is that Ronnie?
Dearie me. I'd burn that one if I saw that. Good Lord.
I wonder if we can get them.
£90 for that thing, for that
Yeah.
pink thing. People are mad.
So that's how to get 300% on your stock portfolio. Find the new craze.
No advice, etc. But yeah.
Find the new craze. Gavin Acker's interesting. I did not know that Jensen had sold 600. Is that 600 shares? No, it must be 600,000. 600,000 shares since June 23rd. Good on him.
Right, so, and he said
Well
what
done.
was selling last week, wasn't he, or the week before as well?
Right?
To pay for his wedding, you know.
Yeah. And yeah, R6 Senna, absolutely right. Block, very strong on Friday evening with, where is it? Block, all sessions, with inclusion into the S&P 500. So Block actually, yeah, that looks good on the chart actually as well, doesn't it? That's been a really tough one to own though.
Yeah.
Because they messed up so much buying the Australian company back in 2020. They added a load of debt. Was it Afterpay?
Yeah, I think so.
They bought Afterpay back in 20. I remember I was sitting in Auckland in a cafe, and it hit the wires that Afterpay, and I was long Afterpay. It's beautiful. What a weekend. Geez, yeah, look at how this thing's come down. Oh my days. 250 down to 17. It's never recovered.
No. At least it's found a floor for now. Every time it's gone down to sort of 50, it's always been a crazy buy. So it's been very solid there.
Now, talking to squares, thank you very much, Chris, for joining me this morning.
And after our little joke to start the week as well. Bill owes me a massive coffee for that one.
I'm intrigued to just what our viewers thought if they had no idea and they hadn't seen the story.
I mean, you could argue it's a great marketing ploy because nobody had heard of the company until Thursday, and now look at it.
Talk about going viral, but also the reenactments as well. All the
Yes.
the American sports grounds with their kiss cams also had people doing it. They call it Coldplay cam instead of kiss cam now.
Aren't they ruthless? There you go.
Brilliant. Right, thank you all for joining us this morning. We have Ange coming up next. She'll be here in 2 minutes. We're going to do a quick changeover, and we'll see you after the break.
Bye-bye.
There are certain things in our daily lives that everyone has a view on, like your favourite clothing brands, supermarkets, or even which airlines to fly with. Loyal to EasyJet and you think British Airways seats are too expensive. Or at Tesco's again because Marks & Spencer's food offering has won you over. Now, what if you could use these views to try and spot opportunities in the markets? Let's talk about pair trading. It's a way to trade that focuses on the share price relationship between two similar stocks rather than taking a view on the market as a whole. Here's how it works. Take Nike and Adidas, for example. Now, some people think that Nike has gone out of fashion recently, but maybe you believe in a brand recovery over the medium term. On the other hand, Adidas Samba and Spezial shoes have been incredibly popular recently. But have sales peaked with this trend? As a trader, you could go long on Nike, expecting its share price to rebound over the coming months. Also, alongside that, you could go short on Adidas, expecting it to cool off after its big run in the last 12 months. It all depends on how you would like to express your own personal view on two companies. But keep in mind how quickly trends can shift. Remember when Under Armour rose to popularity fast, along with its share price. But then they spent most of their profits on celebrity partnerships and their share price performance flopped. Now, this doesn't just apply to clothing brands. Think of Tesco's and Sainsbury's in the supermarket space. Two companies that often move together. Now, if one outperforms the other unexpectedly, pair trading could let you capitalize on what could be a short-term difference. Because the beauty of pair trading is that it's market neutral. If the whole market drops, as long as the gap between your chosen pair narrows, you could still see an opportunity. But don't forget, always research why prices are diverging so you're not caught out by unexpected trends or their financial results. Do you want to give pair trading a try? Start simple. Test it out on a demo account first. It's a great way to learn the strategy without taking on real risk. And on IG's platform, you can explore similar trades easily with access to the tools that you need and further education on the IG Academy.
Hey, Trader friends, welcome back. And I'm joined by Martin Harris. Hey, Martin, how are you?
Good, thanks, and yourself, Angie.
Good. Journey in, because I saw a message saying you're at Embankment now, and then passing Mansion House. Sounded a bit tense.
It's the daily joys of the district line. Is that it's kind of a bit of a lucky dip.
Daily joys of the district. Yeah. Is it going to be a lucky dip for the markets this week? More like, what do you think?
I think there's a lot of momentum in the market at the moment. However, given the very lofty pricings, anything negative in earnings, I think we're going to get a bit of price revision.
Okay. So there you hear it here first, trader friends. Anything that could trip up the markets is Martin's view. Of course, we are in a moment now where we have loads of people on different sides of the fence, some saying that the momentum is so great that this freight train is going to mean that the markets continue to climb this wall of worry. Others saying that we are due for a correction. Those like Joachim and Richie Rich, talking about potentially a 10 to 15% correction in the next few weeks. Just taking a look at the markets here and also just where we're at. This is the weekly chart, trader friends. You can see that it's still on a very strong upward momentum, showing you the daily as well. Bear in mind though, if you are playing the 500, the S&P 500, it has crossed below that upward momentum line that I have drawn there, and also it is starting to plateau, which is only normal, to be fair, after it's risen so high since April. Lots of other stuff coming up this week as well. I've crunched a couple of numbers for you whilst getting live train updates from Martin here. How was your weekend, Martin? Did you do anything exciting?
Watched South Africa play rugby via the pub.
Nice.
Yeah, that was the highlight of the weekend.
And I didn't catch rugby. Did South Africa win?
South Africa won that game, but the more important game was the British and Irish Lions against Australia. British and Irish Lions won that too.
Ah, so you had a big day out then.
Yeah, no, it was a good weekend of rugby.
Speaking of big day out, this is what I have crunched for you, and you can see here that the focus this week, lots of central bank meetings. We also have the election outcome already that we talked about with Issa on Friday, and key challenges, of course, this week as well, not just earnings, trader friends, but these trade war tensions haven't gone away. So at the weekend, I was taking a look and scanning the headlines whilst I was trying to enjoy my weekend, to see if there was any change in that 30% tariff threat on European goods. That still stays, as far as I've seen. August 1st is still the deadline.
1st of August.
Yeah.
I think, so tariffs currently in place equate to about 1.5% of US GDP. The effective tariff rate is about 16% across like the weighted import basket of goods. There's also, there's carve-outs for each sector. So people will say, oh, Trump is slapping 30% on Japan, but Japan autos have their own, each sector within autos, whether it's second-hand parts or something, that has its own defined tariff. So it's a bit murky, but ultimately, market seems to be absorbing it. There was a huge amount of inventory build, front running to try and get ahead of the tariffs. Clear, I saw a note the other day, not excessive, but there was some clear sort of cross shipping between countries that were exposed to tariffs, countries that had less tariffs, and kind of moving the goods between the ports. So there are ways around it, and so we're not seeing the tariffs yet inflation or taking a real effect.
Also, the other interesting thing is, in terms of tariffs, I shout out to a particular person who I've now nicknamed Battery Boy. At the weekend, I went to the Porsche showroom. Now, this is to do with tariffs, people. Dom, if we can pull up the Porsche video for us, I'll just show everyone why I was so excited. It's not so much the car that's in front of me, but behind it, you can see that there are batteries. Now, these batteries, I looked at the Macan 4, I looked at the Taycan, I looked at the Panamera. Now, some of these cars, and many people I've spoken to in Porsche have said that you're going to increasingly see under the bonnet Japanese, Korean, and Chinese batteries.
Okay.
Already, the Taycan, the Macan has Chinese batteries, about 90 if you want to be very detailed here. Now, if you are thinking, trader friends, that the tariff issues are going to continue to hit and hamper these battery makers that go into these cars, then Porsche is going to be a rough ride, because they have banked on the Japanese supplying those Chinese batteries to them. They're more efficient, they're just more cost effective, right? Technology's going a bit faster. So if you were going to do that, I was thinking there's a really good pair trade here. You would short a company like Porsche, but you would go long a company like, for example, Volvo, that have a big stakeholder or collab with Gilet, and they have already manufacturing plants for things like batteries and their parts here in Europe, right? So therefore, they're not going to be hit by these tariff issues. So an interesting one. I highly recommend you have a look at that if you trade the space, because it's worthwhile considering, you know, who gets batteries from where, because there are only few manufacturers of cars out there that are not super reliant on Chinese overseas batteries, basically. Speaking of batteries and tech, big week for technology. We've got the Alphabets, got Tesla, you know, part of the Mag 7 reporting. We also have one other big name that I was looking at. I think it was Intel as well, coming up with numbers. Any of these excite you, Martin? Which one are you looking at?
Yeah, they all. I mean, they all excite me. Let me have a. I want to pull something else up very quickly. News sharing. You didn't tell us which car you're going to get. I think that was the...
I haven't decided yet. I have also test driven the Defender hybrid recently. Quite disturbing that there is, you know, no sound. I find that, you know, it's perturbing. But it's a really difficult one because, for example, the price fall, if you, for example, buy a brand new Macan, will be down 30,000 within the first 3 years. And that's from me, people, not from me, people. That's from...
So just get a second-hand Macan.
Yeah.
Solved.
It's the, yeah. But there are a lot of other Venn diagrams that don't intersect. But
Morgan reporting. We've got Google reporting 29th, Microsoft 30th, Meta 30th, Apple, Amazon 31st, and then late next month, Nvidia, the big one, 27th of August.
Yeah. We also have lots of central banks talking and coming up with action as well. Phil, are you trying to get my attention there? Economic calendar. Here we are. We've got loads of that, you know, coming into the fray as well. So that might move markets. We've got Fed Chair speaking on Tuesday, and then we've got Thursday, S&P Global Manufacturing PMIs. This is the flash number, of course, key one for the markets, given this is forward-looking. And then Martin, take us through the rest.
Well, there's one that's missing on there, which is Bank of Japan, 31st of July.
Yeah.
But we've got 24th of July, ECB, 30th of July, we have the Fed. Then again, as I mentioned, 31st of July, we've got Bank of Japan. 1st of August, tariff deadline, which is going to be the massive one. And we also have late July, so we're going to hear the latest on the China trade deal deadline from Scott Bessent. So that's a big one. And what else? We've got GDP, second quarter GDP coming out of the United States on the 30th. 25th, we're going to have durable goods orders. So there's a lot happening. There's a lot of economic data coming out this week, next week, and into August.
Interestingly, the ECB is still looking at 94% probability of rates holding at 2% after, you know, consecutive cuts there. It's also going to be interesting to see what the manufacturing data, the PMIs, tell us about, you know, the global picture. And also we have, obviously, the Fed continues talking. We've got Christopher Waller speaking later in the week as well. If we see a more dovish stance by the ECB, but we don't see the same for the Fed, this could be potential euro weakness compared to an already weak dollar. So bear that in mind if you are trading crosses to do with the euro. Julian Muster here chiming in. Thank you. I'd love to be the new Top Gear presenter. Just putting that out there to the BBC if you're listening.
Take me with you.
Yeah, it'd be amazing because I really like not just looking under the bonnet, but also I have been known to win medals during corporate days on my ex-boss unfortunately did do one on the track. It was in a one of those tracks near East London.
Okay, is that why is your ex-boss?
She did end up with traction the next day. It wasn't me, by the way. It wasn't me. Keith saying, couldn't China do something to encourage battery trade with non-US countries and companies? Ian, good morning to you. They could do. We are seeing a lot of that happening, you know, within Southeast Asia. However, the US is still its biggest market, right? Europe as well. So therein lies the problem. It is the biggest trading partners that are going to see the biggest impact. Of course, the US wants to use this as a lever to try and get China to bend to its rules and obviously pay more tariffs as well. And they happen to be ahead of the game when it comes to battery technology.
That's right. They're ahead of. So if you think of even any of the battery supply, couldn't China do something to encourage battery trade with non-US countries? They don't need to. They are the sort of the battery manufacturer for most of the non-US sort of auto sector. China dominate 19 out of the 30 strategic materials required for EVs and batteries. So really not a. They already are in the right space. It's really about who else can compete against China at this point.
Yeah, Ian, look up the Macan batteries. They're about that thick, and they're about 90 odd one of those underneath the Macan. Whereas then look up BYD and look up Feather batteries. They're called Feather for a reason. They're not exactly this thin, but you know, you get the idea, the gist, right, with the name of it. Big beautiful bill.
The BBB.
The BBB.
Yeah, stolen from Build Back Better.
Oh.
Yeah.
The BBB, you know, I think this is going to be a shoo-in, not going to be a surprise there. You know, Trump, as we know, has always been able to kind of like get things, you know, that he wants through. What do you think is going to happen? So
I think Big Beautiful Bill Act, it's going to add deficits through to the end of 2026. And then it's going to flip to a bit of a narrowing. I think that we're sort of markets are expecting that BBB adds 50 basis points of GDP growth per quarter. So call it 2% per year just coming from the BBB. They're expecting that by 2026, 70% of the BBB is going to be paid for with tariffs, if you look at the current trajectory. So currently no fiscal drag. So currently BBB, having to say that every time.
The one
big beautiful
bill
is a tailwind for markets. Tailwind in particular for what we've spoken about many times, which are defense stocks. And within the defense stocks, even more so for shipbuilders. So Huntington, General Dynamics, Austral, those are the three big military winners out of BBB. Defense is basically getting this one-time generational spend, both in Europe, if you look at kind of the fiscal response from Germany and potentially what NATO now needs to do in terms of moving to the 5% target, but also now in the United States. So before we used to see European defense, or rather American defense lagging European defense, we're now going to see that boost coming through into the US defense space. So I'm somewhat neutral now on European defense and more on US as they sort of absorb that increased spending.
It's a big gamble, right? Trump is basically taking a big bet that all this is going to stimulate growth, right?
That's right. He's a stimulus guy.
Yeah, he's a stimulus guy.
So, you know, the biggest cost on the BBB are going to be the tax cuts. So it's the extension of Trump's previous tax cuts plus the additional ones. You know, people talk about something like this, or the political football versions of it are like the, you know, no tax on tips, things like that. So that kind of is this political play to really support the American working class, sort of, or underclass, the type of voters who really got Trump and his Republican Party into power. So there is certainly that aspect of it, but really the big cost comes around, it's not so much the spending, but it is the actual tax cuts. So that's the big one, and that's why I talk about this being a real sort of tailwind for a lot of the American companies. Data center is also going to win big. So EU's no less, removing subsidies for buyers, which have been a huge component of Tesla revenue in the past before they were profitable, allowed them to offset a lot of their losses in swapping them out for tax credits. But now I think in terms of the data center demand is insatiable. America basically can't build data centers fast enough for demand. Big winners there. We talk a lot about the hyperscalers. We talk about Nvidia,
and that's why we're seeing things emerge like GPU bonds. Look that up, trader friends. They're kind of popping up everywhere because if you look at a lot of studies, they're all pointing in one direction, that essentially in the next 7 to 10 years there won't be enough GPUs. There's not going to be enough capacity to digest all this extra mechanization and power, data center power, to crunch all these requests, AI requests. Richie Rich's, and I don't know how many prompts he does each day, but he's always talking into his phone, right? Pardon, you're talking to me? No, he talks into his phone. And can you imagine everyone starting to do this, right? Your grandma, your grandpa, Kirky, Ian there, Neil, away with the numbers, Monkey Man, I've seen your prompt.
Is that who Rich is talking to? Because everyone's always wondering,
who the heck
is Rich on
is
the phone?
He's always talking to himself in that corner over there.
Yeah.
No, he's talking to his AI prompt.
If you're on the chat and Rich gives you a call, let us know who you are. Who is Rich talking to?
We're going to have to wrap because Phil says we're running out of time. However, I just want to add one last thing, trader friends. If Trump, I'm going to be devil's advocate here, if Trump's big bet on stimulus and growth does not work, there are data points out there that show you that over 10 years, this BBB is going to average around 1,000 to 1,200 per American per year of added taxes. So they're going to be worse off, especially if this does not translate into growth.
Or they'll be earning so much money that they won't be concerned.
And the dollar will be so low that they can never leave the country ever again. Not that
I've got one last thing to add about BBB and the data centers. Two big winners that we're seeing coming out of this. A company called Eaton, and the second one is called Invent Electric. What do Invent do? They're built, so we always spoke about Nvidia as being the picks and shovels of the AI gold rush. This is now below the picks and shovels. This is not selling picks and shovels. This is selling the jeans and the overalls to miners. This is the Levi.
Invent? I've not heard of that one.
Eaton and Invent. So Invent, they produce
NVENT.
NVENT. So they are manufacturing, marketing, and installing all of the rack chillers, the cooling distribution units, the server racks, the power switches, all the cabling that goes into a data center. And so, you can't order this stuff off of Temu. When you build a new data center and you need 20,000 racks delivered, there's really only one producer who can meet that, and that's Invent. So it's a company that I really like at the moment, Invent and Eaton Electric. Sorry, Invent Electric and Eaton.
Nice. Thank you so much. We are going to go to all sessions up in 2 minutes, so stay with us. Kirky putting his thumbs up there. We love, talking about companies we haven't yet traded or invested in before. This is interesting. I really like that Invent chillers and racks. Stay right there.
Racks and
Welcome
chillers.
to the exciting world of options. If you're looking to add a new dimension to your strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide educational content, trading inside and out. And with our 24-hour servicing, support is always just a call
Bring me the next shiny new thing. Bring me the next shiny new thing.
Right, so we are going into the old session for a quick one. If there is somebody watching that has got a position RTX, I am told that the feed price was wrong, that you were getting a margin call. You should not have stopped out because the stock was looking down 30%. It's not down 30%, is it? So yeah, on RTX, got the wrong data feed on the prices there. But in this all session, we're looking with Tesla up again.
Oof.
Oh, those 380 calls are printing, Angeline.
Oh my goodness me. It's like nothing's holding this thing back, is it?
Intel up 70 basis points. We've got, oh, interesting, the treasuries are also, that big move in treasuries, isn't it? Have bonds moved down that much? Or yields, I should say. What else are you seeing there, Ange?
Loving Alphabet, looking at that, all sessions up 0.2% is ahead of their earnings. Obviously, the entire thing will be based on what they say about AI, revenue generating space that will be its new products that it's going to try and unveil amidst you talking into your AI. Martin are like, you know, if any of you know, like, you know, why he keeps walking off and talking into his phone, and I was like, yeah, that's not a person, that's him talking to AI again. So basically Alphabet, i.e. Google, are really worried that people like you are going to continually use the Claudes, the Perplexities, the ChatGPT, etc., which means that it draws advertising eyeballs away from the likes of Google.
Oh, definitely.
United also out with earnings this week, along with Southwest Airlines. Let's see, Delta.
Nike. Now, I was short the 7250 calls on Nike on Friday, and it closed at 7246. So I got put upon for 4 cents. So I now am the proud owner of 200 shares of Nike, which I'm quite happy about. But straight away, I'm going to write some calls.
I was going to ask you, you're going to offload them?
Turn it into a covered call there. What have we got? Netflix unchanged. Yeah, a whole load of stocks unchanged, really, isn't it? Apart from Tesla, why is Tesla so strong then? Do we have an upgrade or anything?
No, there hasn't been an upgrade. I just think it's, you know, come off recently, and, you know, the cult followers of Tesla probably jumped back in.
Ahead of numbers.
Yeah. And its numbers are out this week. So if you are on the side, the camp that thinks it's going to come out with good numbers, investors are going to shrug off the, you know, bad sales it's had recently for its EVs, and people are going to continue looking at its robo-taxis.
Well, producer Phil's got a... What story did you see, Phil?
Yeah, so if there's easing regulations surrounding the robo-taxis, Monkey Man, thanks for sending me the video of the you know, near misses with the robo unveil a few weeks ago. Have you seen them?
No.
They're quite interesting. Like a truck is reversing back into a parking space, and the robo-taxi behind tries to avoid it by going into the parking space. And so someone had to like stop it just in time. So if there's regulation and an upgrade in that technology there, then that might boost the stock. Others talking that maybe there might be an unveil of some news of this Tesla humanoid, which is seen as the next, you know, cult thing that everyone is going to buy into Tesla for.
Would you rather have a humanoid in your house or getting a robo-taxi?
Can the humanoid clean my toilet?
Yep.
Humanoid.
Yeah. Producer Phil would rather get in a robo-taxi. I'd take the robot all day.
Yeah. And without ruining Richard's jumpers, his jumpers.
Yeah, my cleaner that shrinks my jumpers.
Yeah, that shrinks. Give them to me. Perfect size for me. We wear the same label anyway.
Jokes aside, I've probably got three tops for you.
There you go.
That would fit you perfectly.
There you go. Let's get you through Andrew McKilvey and Steve and Gavin Ackers. I'll always get you the price targets. The only reason why I didn't get it to you this morning was because producer Phil was going, "You're cluttering up the chat," and but But we've got my filter coming through now. See, AI, if you give it the right prompt, does work. So General Motors, JP Morgan raising the target price there to 60 from 56. Lots of car makers.
I think we're on the wrong screen, guys.
Ford also getting its price target raised, but not having much impact. Its shares just up 0.2% there on because it's all sessions.
You got the filter list, sorry, Angela.
Yeah, so I'm just going to put that across for you.
Here we go.
There we are. And so United Airlines, that is also raised to 127 from $101 there. Is that better? Let me see.
There we go. Now you're talking.
Yeah.
Bit further in.
And then we also have...
There we go. Well,
Yeah.
as you were.
Is that better?
No.
Oh.
One more.
Very tricky here trying to do this
That's
with
it.
fingers. Yeah. And so you can see as well, yeah, car makers having upgrades from JP Morgan. Comerica, they run all the big stadiums. If you watch a lot of live sport in the US, like baseball, basketball, and all that, they have had their target price raised by KBW as well.
And what's a bit higher up there? Do you want to scroll to the top?
Yeah, that is the top. So Synopsys, GM, and Ford.
Okay, so GM and Ford. Aha, Mango's back.
Mango!
Welcome back, Mango. Great to see you.
How are you? We were a bit worried about you, Mango.
Mango, tell us, you're asked about the contact phone number. Is it from prices looking wrong? Because we did have an error in RTX. Let me just check that RTX has been fixed. Yeah, there it is. RTX trading 152. For some reason, it was showing sub 100. I don't know if it's with that or if it's with something else. But yeah, Phil's going to put you in the customer service number for IG there, and you might get through to Ronnie.
Or Wardy.
I don't think Wardy's working this morning.
Yeah, and so just taking a look across the board as well.
Sorry, yeah, block we were talking about. So up 9% R6N. Do you have any? Pointing that out to us this morning. MicroStrategy's fallen back a bit. 434 this morning. I think SWC's down as well. And I'm not overly confident about SWC until it does another raising, because it only managed to get 17 million on Friday. So I just want to see a little bit more.
You've always been the view that you're going to wait for the next raising, right? Wait and see.
Well, no, I generally try and buy them in the sort of, below 250 and then sell above 325. But it's all I've never had any doubts in the strategy before. The strategy, he only went in to raise 15 million last week, having last seen him raise 41. Then it just seemed a little bit soft, and I don't know if there was a reason for it. We'll have to try and get Andrew back in.
Yeah,
You'll be able to
that'd be
explain.
great. Yeah, because last week you were saying that it's interesting. It didn't get a higher lift. It was a bit soft. Yeah, get him back in. I'm sure lots of people in the chat will want to know. Speaking of which, we have another upgrade coming in. Morgan Stanley upgrading Pinterest to overweight from equal weight, and Pinterest, all sessions up 3.7% there.
I can imagine you're a bit of a fan of Pinterest, are you?
I like getting ideas, but I don't use Pinterest. Do you use Pinterest?
Never in my life.
I'm that person that if I have to do up a room or something, I walk into like a screw fix and I find someone who looks like they know what they're doing, and then have a good chat with them. Don't ever go into a screw fix; they know nothing.
They know nothing. Right. Palantir up 70 basis points, 154. I have just bought some inverse S&P in my ISA. So my ISA obviously sits long, and it can be 100% long. At this point, as I've shown on the show, I'm 35% in cash for a short period of time. Now I'm using that cash to go short the S&P in my ISA, which doesn't happen very often. The last time I did this,
Was
remember, February 2020,
right.
because I was dating a girl in Sydney who worked for Groupon.
Right.
And she said, my goodness, all the Aussie hotels are desperate to get people in. And they are offering discounts. I've got people phoning me up that I previously had to beg to give me some kind of business before. So that was, of course, the effect on the Chinese not being allowed into Australia in January and February.
Yeah.
And then, so as soon as...
I mean, they were on their knees, right? Anyone in hospitality, basically on their knees.
Yeah.
Interesting. So is this also part of the same rich theory where on Friday you said you'd take all of us out for a huge meal if there was at least a 5% correction on the S&P?
Yeah, I'll absolutely take the whole team out. We're not talking about all the viewers as well.
Oh, you trader friends!
I'd love to have lunch with the viewers, but I'm not sure about paying for it all. Yeah, the drinks at the auctions event was enough.
Tell you what is doing really well, Bitcoin and Ethereum.
Yeah, but I actually got stopped out of my Bitcoin at 11 p.m. last night.
Oh.
That is what is annoying about having stops, because now it's higher than it was when I set the stop. So yeah, that's very frustrating.
Coinbase has had a target price upgrade by Piper Sandler. $150 from 190, and it is climbing in all sessions. It was up around 1.8. It's now up 2.2%. Just showing you my chart there, trader friends. Putting that onto the minute chart so you can see the action there. This is the 1 minute chart. So that is Coinbase, and it's still climbing. Look at that. Look at that move there.
Miners going gangbusters this morning. We got Ferexpo, of course, the iron ore specialist, up 4.6. We got Glencore up 3.6. Anglo American, there it goes. That is new highs for Anglos. Glencore only going back to where it was 2 weeks ago, but Anglos through the highs. This is actually very positive.
My favorite bit, trader friends, of last week was when I had John Mayer on, and as we were talking to John, and John was saying, yeah, I really do think that Anglos is, BHP is going to come
We didn't
back.
think really, he thought possibly.
Yeah. I do that thing again when I look over at Rich, and Rich is like,
Yeah, my eyes almost burst out my head. Not only BHP potentially come back for Anglos, but then Glencore come in as well. That's what he thought was possible. So
RSAX, I think Rich was asking you about block, not square.
same thing.
Just teasing her. And Jugger. If you receive a margin call, the broker will randomly close trades until the call.
That's what Mango was talking about. Mango, let us know if it's fixed, and if it's not, then I shall go and run to the trading desk and get them to sort that out for you.
Ooh. Tesla just hitting more than a 3-week high on Friday. Let's just test to see where it is right now, because we talked about this earlier on. All sessions still up 1.4% there for Tesla.
Ryanair now only up 6%, having been up 10%. So that was a little bit overdone on the open in Ryanair. But there's our two stories of the morning. Stellantis down 2%, Ryanair up 6%. And talking about myself and Joe looking for a pullback. Well, what one of the clients said on Friday, says, I'll tell you what I like about the show is that you show your portfolio even if you're losing money. Well, there we go then. So just for you, sir, let me get zoomed in properly here. So let me show you these call positions that I keep on talking about, the ones that are causing me pain at the moment. And I'll put the losses in there as well. So my 63.50 calls, right, for December, they are trading currently at 280 points. So that is by December. So that's costing me a lot. I'm short the 6400s for SEP. They're trading 114. I'm short the 6500s, the 6600s, and the 6800s. That is how high conviction I have that this market does not continue to go at the pace that it has been going. I don't need it to go down. If the market stays where it is, then my goodness me, there must be about $25,000 to come back. So that's the investment I've got into, just looking that 26% of a rally, I think is enough. And I'm as high conviction here as I was high conviction on the market overdone at 4,800.
Well, you'd be pleased to know that I've been getting Jack to crunch some numbers for us. And he says, at the moment, from the vol side of things, there's nothing indicating there is anything out there to bring levels any higher for the S&P 500. US index daily is getting towards 10%, which is almost a historic floor.
Now, I'm not saying it won't go higher first, but I'm happy to take the pain because at some point between here and December, it would take a very brave person to say we will not trade below 6,350 again before December.
And then I'll be sending all of you the address to the lunch that Rich will be throwing at Marco Pierre White in London.
Oh, no, we know there's only one place we go to lunch, isn't there, Ange?
Oh, Chuck's!
No.
Which one?
Greg's. Where we were going to go to lunch today.
Oh, Tiffany's.
Tiffany's.
Yeah. So for those of you, we have a client who has got a new restaurant calling out Tiffany. I don't know whether I can unveil it just yet because I'll put it in the chat.
Keep it as a secret. We'll show pictures when we do go.
Yeah, because she owns and runs Singapura in Chinatown, near Chinatown. Excellent place. Now she's opened another joint in Victoria.
Right, just to finish up there on other positions that I've got, you see long ASML, long Anglos, short some Antos, short some BHP, short BATS, which has been terrible call. I thought that a rally in the market would mean the defensives get left behind. I've got long Diageo against that, long a bit of FTSE, short some Glencore just from a small trade this morning, and long a lot of Rio Tinto. Double the size of all of those.
Yeah, and Andrew McKilvey, I'm only just up money on Sarabi after speaking to you about it. NATO just putting this up here for you. This is doing well. And I entered at 12.35 and it is now 18.37.
Oh, is that this Wisdom Tree defense?
Han ETF. Han ETF.
Ah.
Yeah, so it's now 18.36.
That's...
Right, stay with us because we are going to have Chris Beecham up next with Trade of the Week and Technically Speaking.
What's it going to be? What would your Trade of the Week be, Ange?
This week. Alphabet.
Terence said go long S&P after whatever that I've just said. Very good, Terence.
Very good, Terence. A contrarian trade. Alphabet.
You go long Alphabet.
Yeah.
God, that's brave.
It is
for
brave.
a Trade of the Week.
Contrarian view here. I just think they have the ability to surprise.
Oh, I'll tell you what's done well this morning as well. Marvell, or Piers' big shout, is now up to 74.90. I've got some of those as well. Ooh, I'm tempted to let those go. I'll call Piers. Let me get an update from Piers.
Take half.
We'll get an update from Piers tomorrow on Marvell, but that is helping against some of the...
The other one that loads of our trader friends want to ask Piers as well is Estee Lauder. So last time he was on, he said that is, one that has been unloved for so long, and he thinks it's going to... He's bullish on it now.
But remembering that he is a tech expert. He is not an Estee Lauder expert.
He's not an Estee Lauder, but he was so convinced by it. He was like, I need to talk about this, Ange. I really need to talk about this.
That's like me talking about home improvements. Right, Chris Beecham is knocking on the door. We don't want to, after me and his romantic moment at the start of today, we don't want a fallout.
Have you seen the latest product that they're selling off that balaclavas in case you want to do that?
at a Coldplay concert.
At a Coldplay concert.
Very good. Right, like, subscribe. Please hit that subscribe button because 53 subscribe. I don't believe it. What's stopping you? What is stopping you subscribing?
Don't be shy. Don't just be a silent viewer. Many of you came up to us at the Tasty Trade event saying that, oh, I love listening to you and Rich every morning, but I'm too shy to comment. And I said, have you subscribed? And I went, no.
But we've only got 16 likes this morning, which is the lowest that we've had for a while. So that if you would just come across to your computer and hit that like button that is underneath the program, that would be great appreciation.
Yeah, and it will also help us get you more guests that you like watching here, because this is for you. Don't forget, this is a community show, so we are driving the guests and commentary and the research for you, unlike places that just give you what they think is the news agenda of the day.
Beecham's about to come in.
Kicked out. Yeah, right. So we're going to have to love you and leave you, but we'll be on the chat.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Today we're here because we've recently launched our Save Our Stock Market campaign. We just want to raise awareness for terrible cash returns that everyone is getting with their money in cash ISAs. What we want to do is raise awareness for the great returns that you can get on UK stocks and help revive the UK stock market and get people investing.
There's a lot of bad feeling about the UK stock market, and it's really negating people's view on the UK market as a whole. There's some great companies. If we just start the ball rolling on people getting behind the UK stock market, then we can start to get the interest, and it's days like this. We get awareness of all the crowds talking about stocks. It's really that awareness, and ideally we'd like to take it to the government. We would like cash ISAs to be reduced, not because we don't believe in the chance of people saving, but more that you get higher returns, as much as 7 times historically, in investing that you can from cash. And that's not saying people go out and take a load of risk. It's about education, and it's about helping people to understand the benefits of investing and the limitations of holding their money in cash.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns, that's something else. Watch and learn. Come on, Pat. Cash returns, go. Hey guys, where are you going? You're not going to get better than cash returns.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Okay guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat. Come on. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
We're watching a crisis unfold in the UK, and we need to take the envy of the world is in a dangerous downward spiral. At the same time, the UK is stuck in a damaging savings-first mindset with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policy changes our stock market badly needs. From scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings and using incentives rather than penalties to get people backing British firms. And to show we're putting our money where our mouth is, we'll be offering every new customer who joins IG across July and August a free UK share bundle. For too long, policymakers have been paralysed by the desire to keep everyone happy. But the time for working groups is over. This is about getting more Brits investing while saving a strategic national asset before it's too late. You can read more about IG's SOS campaign and free UK share offer on our website.
The Monday, the 21st of July. It's not Axel Rudolph, the more attentive of you will have noticed. He is sunning himself in Turkey for 3 weeks. So how the other half live, eh? So you get me instead, Chris Beecham. Usually Axel goes really distant places, you know, China, the middle of Africa. He goes diving in the Red Sea, and then you panic because it takes ages to get back. But hopefully Turkey, there should be no problems getting back. Because when he comes back on holiday, I go away. But anyway, that is by the by. Let us go to Trade the Week from Monday, the 21st of July. Let's go first what we're actually going to do this week. They were frantically guessing earlier in the gallery, but I can now. We are going onto a chart. There we go. Here we are. Dollar yen. This is our trade of the week. We're just going to move this, get rid of this one. We're going to go short dollar yen, which is, I think, interesting because you've seen this very steady rally in dollar yen, but you've seen it top out really over the past week or so. Yeah, week or so, but up to just below 149, which is roughly in line with where we saw resistance come through the 12th of May as well. So remember, this comes off a continuation of really being short US dollar all the way through the year. It has had a very strong rally. You have had short-term uptrend off those post-tariff lows, but we are going to look at going short. Well, let's look at last week's trade very, very briefly, because that was closed out because we were short the Aussie dollar last week. If you look at this, with our target is 65, and Axel being a bit of a technical whiz, as you know, we did go short this one on last week at around 66, 65.80 with the target of 65, which it duly delivered by Thursday. So a very quick one and done on that one, delivering on our trade there. So we closed that one out. If you go back even further to the previous week, so that's the 7th of July, if you can think back that far, that's also short Euro sterling, which is still in effect because our stop is up here above these previous highs, because his rationale was you've seen momentum beginning to weaken across the board here, which might argue at least for a short-term pullback. So if you're looking at these trades of the week, looking at still a short euro sterling for the time being, it is moving in that direction this week. So one to watch, particularly as you've got the ECB meeting on Thursday, expected to leave rates unchanged. So one to watch there. But this week's trade of the week, as I say, we're going short, as you can see on here, short dollar yen, with a probably initial target down towards maybe 146, which were the lows on the 10th of July. We put our stop above these previous highs. Don't put it right on the highs, give it a bit of room to breathe. So actually give it to 149.50 is our stop, short dollar yen. So that's this week's trade of the week. Thank you very much. So, I'm getting good at this at some point. Into technically speaking as away, so you get me as well. Do any suggestions coming through? Do get those in early, and we will do our best to cover. For the time being, let's go back to everyone's, well, certainly one of our favourite. Let's go back to the Dow, which is, we'll just flick our chart back. Just as we go on, it's not a technically speaking question, but we'll let you have it. Andrew will let the stewards inquire on that. We're not worried about Japanese election fallout. Is this a reference to my earlier comment that I was furiously revising Japanese political news over the weekend for the election? It doesn't seem to be at the moment, because it looks like the current PM remains in place, although with a weakened majority. So it's one to watch, of course. As we said in the morning show, it is a holiday in Japan today, so we might see maybe a bit more concern coming through. But yeah, going back to that trade of the week, we're going short dollar yen. So expecting the yen to strengthen, perhaps will be helpful. We'll be given some luck if Trump decides to have a go at Powell again. So that's one to watch. Do keep those requests coming in for charts to watch. In the meantime, let's start with the Dow. Let's go with this one here, which is a bit of a, obviously one of our most popular markets. Where is it going from here? If you look at seasonality for the chart, we've got one request in. Thank you, iDarek. We'll do BT in a second. Let's just do the Dow, having started, so I'll finish. Consolidation maybe, sideways movement. You saw a record high in this index the 3rd of July, just ahead of that Independence Day holiday. Usually US markets rally into Independence Day. Historically, the first half of July is the stronger one, so we could argue maybe for a bit of short-term weakness, but you've seen quite a bit of recovery here off these lows back above 44,000. So I still wouldn't be surprised to see it push on back towards this 44,890 high that we saw from the 3rd of July. It would not surprise me in the slightest. Let's go with BT. It's always good to start with a company that I've heard of. Of course, reporting numbers this week. BT Group PLC, there we are. And let's start with the daily chart. And that is, of course, it does not take a technical whiz to look at why that's in an uptrend. Of course, further steady appreciation of the price all the way through from these April lows. Indeed, very much going back, gosh, how far do you have to go back now for the start of this uptrend? All the way down from more than a year ago when BT bottomed out at just above £1 a share. So a very impressive performance on that front for BT. So doubled in just over a year. For what is, let's be fair, a slightly boring stock, BT, not everybody's idea of exciting growth stock. But here's where it gets interesting. Let's look at this monthly chart, because lo and behold, where are we? Back at £2 a share. And this is getting in right at the crucial area, just above it as well. But look at these highs from June of 2021 and February of 2022. Those highs at £2 a share. Someone asked me last week, why do markets love big round numbers? Why does it matter? The answer is, it doesn't massively, but it's notable how often you see markets become quite skittish around these big round numbers. And what it's telling you here is that after this huge rally from February, at least, from £1.40 to nearly £2 a share, you might see a bit of caution creeping in. Previous resistance, always a level worth watching. That said, if you can see it push on, if we do get a bit of good news this week from those numbers, of course, that's Thursday, along with Vodafone, a bit of a telecoms day for UK stocks on Thursday. You've got also these late 2019 highs at £2.12 a share. And if you talk about support, here's your exemplar. £1 a share, just below £1 a share around September 2020, where BT shares bottomed out, then rallied, doubled in the space, back down to £1 a share by the beginning of 2024, but here we are up again. So sideways market in BT over the past 5 years, which of course is a reminder that markets don't trend all the time. You do get these long-term sideways movements. Frustrating as a long-term shareholder, of course, it's delivering you a dividend as well along the way there for BT. So that's enough for BT. Andrew McKelvey stirring the pot here with the S&P 500, asking why Rich should be worried about his trades. It's not for me, of course, to cast aspersions on another person's view. But here we are yet again. It's every Monday I get on with Rich and we talk about stocks, and he tells me why I should be worried about the S&P, and then it goes to another record high, which could well happen today if we turn on our high-low data, which you can do on the platform by right-clicking. Our high there is 63.18. Where are we now? 63.14. Still plenty of strength coming through, and you did see quite a bit of support entering, buying pressure coming through at 6,200. That's what support is. Let's boil it down to the essentials. When we draw a line on a chart and we say that's support, what we actually mean is that's where people stepped in to buy the market. Ignore the thing, S&P 399, the moving average. I was just faffing around with my charts. I think I was seeing how high I could go. So ignore that, Raoul. Don't take that as gospel. What I normally use with my moving average, 50 in the blue, 100, and then 200. And then it's not, the platform is not playing ball to, there we are, coming in. There you can see the red line there, which sort of gives you short-term, medium-term, longer-term trend, if that makes sense. But yeah, S&P 500 points away from a new record high. Let's see if it does it today, and then on from there, really. As I say with the Dow, second half of July, bit of a sideways movement. The S&P tends to be slightly weaker. Normally, though, July's are actually a very positive month. August as well, despite its reputation as a volatile month, is positive, I think, over the last 25 years, if my memory serves, on seasonality. So there we are on S&P, possible around 6,200, perhaps deeper pullback down to 6,073. Don't forget where we've come from, down here at 4,800 on the S&P, now up at 6,300. That's an awful long way to come in what is a relatively short space of time. So you should expect, and this is the kind of thing analysts would say, but you should expect between now and, say, the beginning of October, at least some volatility to creep in. It would not be surprising, even to see it back down towards 6,000, get everybody nicely bared up into the Q4 rally would not be surprising at all. So there we are, the S&P 500. Oil request there from Shrimp Fred. What an epic name there. I'm going to go with US crude. If it's the other one, do shout. So I'm about to launch into the spiel on US crude. Oil prices at the moment, yeah, it's an interesting performance because you've had obviously an announcement. I think this is going back to the 11th of July. We had the announcement on the increase in production from OPEC, and oil prices essentially shrugged their shoulders. But you did see, look at this here, 68, 67, 70, 67, 80 around here. Up to 6,800, sorry, 60 stopped there. There was quite a bit of buying weakness last Wednesday around 64.70, but just again losing a bit of momentum in morning trading. So maybe again shifting to the downside here, which is interesting given the way sentiment has shifted around the outlook for the global economy this year. Maybe some tariff worries yet coming back into this one. But now watching to see whether it can make another push back towards this 64.50 low from what we saw on the 16th of July. There was a lot of support coming through those post-ceasefire lows in the Middle East. 6,400 was the floor on that one. Interesting, of course, because as Axel will point out, support there around 64, that's previously resistance from the 20th of May. So the key one to watch there if we do get a bit of a move to the downside in oil prices. Don't forget to keep, if you have, at the moment, we can quickly look at also maybe gold prices. Definitely want to keep an eye on as we go into the week, because it could be, and this was potentially when my chart deigns to load, could have been one of my trades actually. Oh, a new one from Jugger, that's one from me. Let's see if we can find that while gold decides to load up. Oh, I think my internet issues have come back again. That's always good. Let's see if we can get one more in before close. I think it might be, we might be losing this one. We might have to call that to an early finish for some reason. I don't know why my internet is not happy this morning. Technical issues. Thank you for that, gallery. Yes, it's a sabotage. It's Axel from far away. He doesn't want me to replace him. I think think if that dies,
This is
we're going to
just
have
the
to
minor
wrap that one
retracement.
here. I think we might need to just wrap that one up there. Apologies, Jugger. We were going to look at QBTS. Tune in next week. Apologies for that one. Thank you all very much for joining us. Sorry it wasn't quite the seamless session we'd have hoped for. Don't forget to like and subscribe. There we go. I do remember some things Gallery tells me from time to time. If ever a round of applause could be sarcastic, there it is one. Thank you very much. Thank you very much, everybody, and we will be back shortly.
So we have Garth McKenzie, who is from Traders Corner and talking with traders. Run us through this wonderful website that you've constructed there with, I think, it's almost from our offices. Is it that picture?
Well, it's an old picture because you can see that the shard is still being built.
Of course.
but yeah, I mean, obviously that's looking up the Thames in London. The website is traderscorner.london. So basically that is where I publish all my market strategy. I do a thing every day called the Daily Desk Journal, looking at what I'm doing in the markets, where I'm seeing opportunities. It's up before 8:30 a.m. South African time, 7:30 a.m. London time.
Nice.
So I'm up early in the morning working on this, putting together some strategies, very much technical analysis focused. And then throughout the week, I have some other reports which are more long-winded, let's say, than the Daily Desk Journal.
And views.
Views on, stocks, both international stocks as well as South African stocks, where I have a lot of clients still down there.
Brilliant.
Yeah.
And as for the podcast, we're on, number 130, did we say?
Yeah, that round about 130. I lost count, but we're thereabouts. So it's talking with traders. We started this in 2020 during the pandemic. And actually, it was something that IG sponsored at the time. And initially, it was supposed to just be 6 episodes, and we would just test the waters. And we did 6, and it was well received. So we thought, let's do another 6. And it kind of just went from there.
That's incredible.
And it grew and grew. So I've had some great guests on over the years, some quite high-profile names as well, which has been a privilege to interview, guys like Tom Sosnoff.
Oh, Sosnoff has been on, has he?
Sosnoff's been on from Tasty Trade. Yeah, I mean, it's a privilege to talk to experienced traders, to get their insights, and effectively to get 40 minutes of their time, undivided, and ask them questions. It's a real privilege. And over the years,
exactly what we've stolen from you today.
Well, there we go. Yeah.
Now, take us through what kind of lessons you learned from speaking to that many experienced, professional, and wise traders.
Well, there are so many lessons, but there are certain things that stick out in your mind, and certain little quotes that always stick with me. What I will say is that all of the traders have different methodologies, different time frames, different ways of analyzing the market. The one thing that all the successful traders do have in common is risk management. Mm-hmm. They keep their losses small and try and maximize their wins. Right. And it really, that is the one commonality that I've seen across all traders.
Yeah.
And if you read any of Jack Schwager's Market Wizards books, that's also the same commonality that comes across with everybody. But there are many. One of my guests once said, and it just sounds so obvious, but he said, in this business, you have to take risk to make money. You get paid for taking risk. Yeah. And it sounds obvious, but if you stop and think about it, that a lot of the time people don't appreciate that, or maybe don't understand it at its most basic level. You have to take risk in the market if you want to make a return. If you don't take any risk, you're going to make nothing. But at the same time, you have to manage that risk so that it doesn't wipe you out either. And it's obvious, right? As traders, you have to take risk to make money, and you get paid for taking risk. But if you don't take the risk, you ain't going to get paid.
And there's an easy way to not take any risk in life. Stay in bed.
Yeah.
Right? What's your payoff there?
Exactly.
Yes, you could get hit by a car on the road. You could, go on holiday. The plane could crash, whatever. But it's always about judging probabilities. Yeah. When to take more risk, versus the return that you think is likely. And that's where, is there a feeling that sometimes 3 or 4 times a year, there are huge opportunities.
Most definitely. And that's the thing that I found throughout my career, is that as a trader, most of your year's returns, actually, when you really look at it, often come from 3 or 4 trades. And in between that, you're scratching around, you're making a bit, you're losing a bit, you're making a bit, you're losing a bit. But the point is, and I often liken this to scratching for diamonds. We talked about De Beers, so let's take it back there. But I think about it like scratching around for diamonds. You've got to be scratching if you want to find anything.
Yeah.
You're going to probably find a lot of dirt. You're going to dig up a few small diamonds. But if every once in a while you'll dig out a big diamond. And that's kind of the way I view the market, is I scratch around every day. I'm looking through the charts, looking through the opportunities.
Right.
You don't know when the next big diamond is going to reveal itself, but it's there.
The diamond's the opportunity, not the profit.
Well, yes.
You're trying to just find that opportunity that sticks out, and you're scratching your head and you think, surely I don't have that growth with that yield at this price.
Yeah. Well, that's it. And you're quite right in saying that there are a handful of these that come around every year. And you've just got to keep your eyes open.
Yeah.
Look for them. They're not going to fall in your lap. That I can tell you. You need to be doing the work. You need to be scratching around, reading, looking at charts, following the news, seeing what's going on in the world. But by doing that, the opportunities will reveal themselves. And then it's a question of knowing when to act, how to act, but how to manage the risk as well on those things.
Because is there a recurrent theme of when people get burnt and when they take big hits, upon reflection, would they now know how to miss those?
Well, I think it comes with experience. You learn how to manage risk. Look, every trade that you go into, it's a probabilities game. You don't know whether it's going to be a winner or a loser. Sometimes you can have an opportunity that you think looks like an absolute sitter, and it doesn't work. That's happened to me as well. Right. So you've kind of got to go into every trade knowing the risks and knowing what your plan is if it doesn't work out. Where's your stop loss? How big is your position size?
Yeah.
Where do you call it quits, right? And I think that's we talk about a lot of the commonalities of what successful traders do keep losses small and maximize winners. What unsuccessful traders do is the opposite. And unfortunately, we see far too much of that in the retail space, especially where a lot of traders will allow their losses to grow and to the point where they become too big.
Yeah.
But they're also then so eager to snatch at small profits. That's not the way to do it, right?
But it is so common, isn't it?
It's so common.
Yeah.
And it's kind of human nature.
Yeah.
And you've almost got to train that out of yourself as a trader to be comfortable holding winners. And that's not an easy thing to do. In my experience as a trader, the hardest thing to do is knowing the right time to sell, right? Getting a good entry, can do that. Cutting a loss, can do that. Knowing the right time to sell, very, very difficult, because you either often you sell too soon, or maybe you stay too long and overstay your welcome and end up losing some of your profits. So it's a tricky one to navigate, that managing profits as well.
But selling for the right reasons.
Yeah.
Not selling because you've made a profit.
Yeah.
That's one of the real main keys, is that you see a nice big blue number, and that should have absolutely no effect on whether you choose to stay in the position or come out of it.
Yeah, exactly. Don't trade based on what your P&L is doing. Trade based on what your strategy says, right? Like an example right now, we didn't talk about cryptos, but Bitcoin's broken out. I'm long MicroStrategy at the moment. Caught a nice break there. It's moving higher. The trade is working, and it's so tempting to grab the profit. But my rules are saying stick it out, because this thing's running. Short interest in the stock is still very high.
Right.
All the drivers are there for it to actually keep moving higher. Try and flex that muscle, that holding on muscle. It's a difficult thing to do. But I mean, look at some of those. Look at that move on the left-hand side of your chart there now. I mean, imagine you rode through that. what would have been so tempting, right, in the bottom left-hand corner of that chart would have been to snatch at that profit once you had it after that breakout. But look at what you would have missed on the upside. And now we sit in
You would have missed that, but you also had another opportunity to buy a stock that doesn't pay a yield.
Exactly.
You could have bought them at the same level. And this is exactly what I think will happen with Palantir. We are here in Palantir, and you will get an opportunity to buy them somewhere down here, whether that's 90, 95, 100. You know, nothing keeps going up in a straight line. It never has.
No, you're quite right. Nothing does go up in a straight line forever. And especially when you get something that goes parabolic like that, where the chart, the steepness of the trend becomes steeper and steeper and steeper to the point where it almost looks like it's going to fall over backwards. That's often the time to be the most careful. And I mean, I agree with you. I think at some stage you will see Palantir come back again and you'll get an opportunity to buy it cheaper. But you know, if you're in it now, I mean, I guess my thinking would be, you know, run some sort of a trailing stop loss. Maybe it's a break below the prior week's low is your exit signal. If it doesn't do that, if it doesn't break below the prior week's low and it keeps on screaming higher and squeezing up and up and up, well, then maybe there's more money to be made. You know, let the market reveal that the top is in, as opposed to just trying to guess where the top is going to be.
I do think it's different in something like Bitcoin, because Bitcoin isn't necessarily a thing in itself. Maybe gold's the better example, right? Gold isn't a thing. Gold is the opposite of the government and the government's discipline on budgets and the central bank's discipline on things like QE. So all I'm doing is actually being short government discipline. That's my view on holding gold. And therefore, I'll hold this till it's 5,000.
And also what you're also doing by holding gold is you're effectively short fiat currencies. If you look in history, the one thing that fiat currencies do all over the world is devalue. Right? Because governments print more of it and more of it and more of it. So go back, you know, as far as you want to, and you'll see that over time, fiat currencies devalue. What hasn't devalued is gold. Gold's been the ultimate hedge against, as you say, against governments, against weakness in fiat currencies. So it's a great hedge. Unfortunately, it doesn't pay you any yield. That's the downside of gold. But it does preserve your purchasing power over the long run.
Garth, thank you very much. That time has flown. Wonderful to chat.
Thank you for having me.
And yeah, just a reminder on where people can find more of you and the podcast.
So my website's traderscorner.london, and the podcast is on YouTube. It's Talking with Traders, and you can find it there.
Fantastic. Great to chat, and we'll see you again soon.
Thank you.
Can't stop this market. New all-time highs.
It's Thursday, July 17th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Mike Butler in studio in Chicago today. Dylan Radigan will be back next week. We're here for the next hour. Futures market closes at 5 Eastern, 4 Central. If you're on the platform, Tasty Trade, on the website, tastylive.com. Thank you for joining us. Welcome to the show. Come over to YouTube. Tell us what you think of this market today, where good news is good news again, Ilya, because retail sales beat expectations and initial jobless claims were a little bit softer than anticipated. A market likes good news, and so stocks led by your Russell 2000, small mid-cap growth lead the way today. Likewise, we see a NASDAQ close at fresh all-time highs on a seasonal peak of the market for the month of July, at least for the next 2 weeks. But it was a buy America kind of day, Mr. Butler. What did we see? Bonds up, gold down, dollar up, and stocks up. That's a sign of faith in this market as volatility continues to come in. We have a lot to cover here today, though. Mike, I'm going to give Ilya a quick second to collect his thoughts as our resident bear here. And as a fellow bull...
Oh, my thoughts are collected. Don't you worry.
as a fellow bull who is trying to fly close to the sun before our wings melt, how are you handling this market?
I'm laughing every time I open it in the morning. And I'm really just keeping positions light. I mean, when volatility is low, there's not too many opportunities to sell premium. So I'm going more the diagonal spread route. I'm kind of cherry picking certain products that have higher implied volatility. Like I've got position on an IBIT, which is a great Bitcoin vehicle. I've got Ethereum positions on now and ETH. And then just throwing on some earnings trades. Like I had an earnings trade in Netflix today. So just keeping things light until maybe something shifts here. But until that happens, I don't really want to have a ton of risk on. But I'm still playing it to the upside because permabulls seem to prevail time and time again. Right, Ilya?
I mean, so far.
Before you get into it, Ilya,
S&P didn't break its high, so
we have Netflix earnings.
I remain undeterred, but whew.
Netflix earnings are out here. EPS of 7.19 beats the estimates of 7.06. Revenues 11.08 versus the estimates of 11.05 billion. It's down a little bit here after hours. Mike, I saw a piece of research today suggesting that the last 10 earnings reports have produced an average move of 8.5% in Netflix the following day. Maybe that's not right. That seemed a little high. But I believe that the implied move for today's earnings report was like right around 7.5%. What do you take of this? Did you have any plays on? You said for Netflix. Is this a Netflix and chill market?
It is. Yeah, I think they were due for an inside move. I mean, they've just had an explosion to the upside. I personally think this is kind of a front-running move to new deals and new exposure to different sectors. I think Netflix is going to land UFC. I've been thinking that for a while, but it seems like there's more news that's coming out, and I think that could create a template for a lot of other major sports leagues. I know NFL already is involved. You have some boxing events on there, but you could see a lot of other revenue drivers. I mean, they made a killing last year with just like a handful of NFL games. So, and then of course, if you consider the fact that they're probably going to split the stock price, I would assume at some point here, maybe a 5 or 10 to 1 split, that makes it more accessible for anyone that wants to invest in it. I mean, it's craziness. But yeah, to your point, pretty decent expected move, almost 80 points. I threw on an Iron Condor in August. There's really nothing else you can do other than credit spreads or debit spreads that are kind of narrow in a $1,200 product. So I had my short options were at 13.15 to the upside and 11.50 to the downside. So almost a 200-point range with 30 days to go. I collected half the width of the risk and just figured, even if it was a big blowout move to either side, a 200-point range in a product like Netflix, as long as it passes through your range, if you do nothing, you'll be fine over the next 30 days. So we'll see. If we open up down 10 or 20, that'll be like right in the middle of the spread. If that's paired with a nice vol crush, maybe we can see $150 come out of there overnight.
Well said. Netflix here, I don't see anything about a stock split just yet, but we'll keep an eye on that here. Tom's talked about how this is, given where the pricing is, it's a little bit of a difficult product to trade, but revenues are up 16% over the quarter. That's not too shabby. Ilya.
You know what, though? This is a surprise relative to forecasts of just 1.7%. So this is, it makes sense that Netflix is idle here. This is bang on expectations for the most part, especially when you compare it with a 16.5% beat last quarter. So it seems to make sense that there's a level of benchmarking here where the markets kind of said, well, how many quarters in a row can they do this? They obviously surprised markets by a lot last time, and analysts adjust. So this is pretty much as expected.
You put out a quip that the S&P 500 wasn't looking like it was cycling to a new high today. I would digress and suggest otherwise, but
it didn't close above it.
Why do you think that the retail sales report today was hollow, which the market seems to be celebrating?
So the market looked at the headline figure, and the headline figure was unmistakably better, 0.6% versus 0.1% expected. And then, in fact, if you actually go down the list, all the various kind of permutations of the retail sales data, excluding this, excluding that, holding this constant, holding that constant, all of it better. But there is an important detail here that's missing in the headlines. And then when you look under the headlines at the components that made up this thing, you find something a lot more soggy. So motor vehicle sales make up about 20 to 22% of overall retail sales. It is by far the dominant component. That should be relatively straightforward. What is the most expensive retail thing that people buy other than housing, for which there is a separate set of numbers because housing is obviously huge and special? It's cars and vehicles of every kind. So not surprising that when you count up retail sales and take volume multiplied by dollars spent to get a value, and then you look at that over time, motor vehicle sales are going to be the biggest thing. Well, if you look at what motor vehicle sales did this month, rather than the previous two, you get a nice little bounce of 1.2%. Except for in May and in April. In May, they fell 3.8%. Huge. In April, they fell 0.7%. Not small. So you take this 1.2% bounce, and what you end up with on net is retail sales fell about 3.3% in the second quarter. That's after the weakest contribution from consumption to first quarter GDP in almost 2 years. And the only thing that really matters for GDP is consumption. It's 68%, 68, 69, depending on the quarter, of the overall total. So what these numbers tell us is that after a soggy consumption quarter in the first 3 months of the year, we're going to get a second one in the second. That the second quarter is again going to be weak in the one area where you don't want to be weak. And the Atlanta Fed GDP Now cast, which was of course updated with this data, very pointedly showed you exactly that. Now, never mind whether this forecast is right or wrong on the number itself. That's not significant. We're still a ways away from second quarter GDP data. A bunch more numbers are going to go in the pot here, and we'll see. The important thing is when they published their update of the model just today, they said, we have to lower our second quarter GDP forecast in the wake of these better than expected, quote unquote, retail sales numbers. Because what we actually have to do is we have to revise down, and I quote, personal consumption expenditures growth. Now, you'll show us surely in a second that some of this was an inflation adjustment because we had untoward inflation data earlier this week, showing us both in PPI and in CPI, most importantly for retail sales because that's consumers, that tariff-based inflation is finally starting to show up. So none of this adds up to a happy quarter in the second quarter and through then the first half of the year for the most important catalyst, the most important engine of U.S. economic growth.
Tech closed at highs today. Banks are closing near highs. At least you see KRE and
well, I mean, as ever, the economy is not the market, and the market is not the economy.
That's the case, Mike. Why wouldn't we keep this rally going, even if it's a hollow retail sales report, as our Soviet friend contends?
Rallied on the hollow report.
I think you will see it continue higher. I mean, really, if you just isolate volatility and the impact of low volatility on markets like the E-minis and NASDAQ, you will almost always see a slow grind higher. Now, the last couple of weeks have not been a slow grind higher, but I think what you've seen from July 3rd on, where we've just kind of like chopped around, volatility continues to contract, we keep pushing to higher highs. I think unless something changes where we see bigger moves day to day and a vol impact that is sizable, I think we will continue to see this just grind higher. I hope we don't. Honestly, I hope we get more two-sided action. I want to see more 100-point moves in either direction. But you know, when we're at peak complacency, which is what it feels like right now, that's typically when fireworks start to rear their head. So we shall see.
Why do you say peak complacency? What metric do you use for that?
When I say that, I'm just looking at like the VIX. VIX is at 16, making new lows every day. It's not as low as it was a couple days ago, but it's trending towards that line. And we've stayed elevated, which is interesting. We haven't gotten back into the low teens. But I mean, a VIX of 15, 16 is typically a grind higher type environment, I would say.
We like doing sentiment checks around here. Do you think the official White House Instagram account putting out a AI video of American Eagles dropping Benjamins everywhere is a sign that maybe we're close to a top?
Maybe.
Wow. I didn't see this today. This is almost better than an Economist cover.
It might
From
be.
a guy.
I feel so much better about my shorts.
From a guy, an administration, the first
I wish
week
you
of
shared
April.
this with me sooner.
First week of April, Besson saying things like, for years it's been Wall Street's turn, now it's Main Street's turn. I'm not looking at the stock market, right? Isn't that what the president said on several occasions in March and April?
Hassett said there's a 0 chance of recession, which means there is a 100% chance of recession.
It's all a little, it's a little too funny. So yeah, things feel a little frothy, right? We have our little sentiment checks around here, but the White House celebrating the market up at all-time highs feels a little different than the attitude they displayed in March and April, and certainly the first week of April. But then first week of April, Trump starts saying things like it's a great time to buy stocks. And if you listen to the president, it was a pretty good time to buy stocks back in that first week of April. So maybe the fact that they're celebrating means that they're just going to pump this thing, Mike. They know how much it means to people that crypto's up and stock prices are up. And, you know, if they can't bring down yields, at least they can give people a wealth effect.
Yeah, I mean,
market's just ripping right now.
Yeah, there's always that angle too. But I think it's interesting too. Like I've been checking the interest rate forecast every day, and almost every day we've been getting a higher and higher probability that there is no cut in September. What is your
Meanwhile,
feel for
the
that?
2026 outlook keeps getting more and more dovish. The markets are pushing out the cuts. In fact, they did it again today. in the wake of these, again, quote unquote, better retail sales numbers. The upshot from the markets was right. So it's not that anything is great. It's just that it's going to get pushed downwind again, which, by the way, obviously makes sense in terms of the inventory build, in terms of the front running of tariffs that we saw in the first quarter. I mean, there was a 40% swing in imports. We're only just now in June, based on the CPI data this week, starting to a little bit notice that goods inflation is creeping into the market, and into the economy. So we're starting to see it, but of course it's delayed. The great unknown is how long, and the markets are clearly saying, right, so the Fed is resistant. They're maybe not even going to get off a second rate cut this year, maybe just one. They're down to 38 basis points for this year, to Mike's point. For next year, they're out to 73 basis points against the Fed's forecast of 25. So the markets took this data not to mean that things are good, but that things will get worse later.
I don't know. Bond yields at the long end of the curve were down today, all while stocks rallied and the dollar
moved up. I wouldn't go so
up.
far as to say they were up or down. They didn't do much of anything. In fact, they've been stuck, basically.
Let me put it a different way.
Basically.
We had a decline in Fed funds expectations at the start of the month. When we started to see those July cut odds go down towards zero, when we see the September odds go from like 70, 80% to where at the market close today, it's a 55% chance that the Fed cuts in September. That is so on the line. We haven't had to bring up this stat in a while, but it remains true. Go back to 1998. Every time there's been a Fed meeting, the day of the Fed meeting, as long as the market's been pricing in a 55% chance of something happening, the Fed's done that outcome 100% of the time.
Right.
So if we were to go into the September meeting, a cut is priced in, but at 53%, there's no guarantee that even though it's favored, it actually happens by the historical metric. But I would point out that while we see the erosion in Fed cut odds throughout July, we see bonds get hit, and yet today it's a Buy America day. Cut odds are down, but for perhaps a good reason.
Well, yesterday we had the spook that we had, clearly, right? And what we saw was this sell America dynamic around the idea that perhaps the White House would be so foolish as to try to fire the Fed chair. And to the White House's credit, within an hour of the rumor mill starting to spin, the president came out and said, whoa, no. That's not what we're doing. So today the bonds do nothing because, again, there was a conversation with the president and he decided he was going to undo some of his own calming effects yesterday and said, we're not going to fire Powell unless it's for fraud. You go, wait, what? So
that's what this whole Fed renovation story is about.
Yeah,
they're trying to dig something up so that they can find reason to find cause to remove him.
Right. So this just tells you that it's not that the president has some sort of institutional instinct that would prevent him from an illegal firing of a Fed chair, which even the Supreme Court has now told him is not a thing that they're sanctioning. But it's that they need an excuse. And so the bonds essentially go nowhere today and go, well, this is either red meat for the base or some kind of something. This maybe prolongs using Powell as a bogey, as a talking point. Maybe there is no intent to fire him. Maybe there is. Maybe they find something. Maybe they don't. Obviously, they're attempting to drum up some sort of kangaroo court situation with the renovation of the Fed's buildings, as you were just saying, Chris, in Washington, D.C., which absolutely no one cared about for the longest time until suddenly an excuse was needed. Echoes of the Soviet Union ring in my head as a former Soviet. But when you look at all of this in context, it makes sense that the bonds don't exactly reflect Fed policy odds in a clean way, because this whole, are we going to tarnish the Treasury as a risk-free asset now and for all time, is a big, big, big deal, and it's not looking as safe today, perhaps, as it did yesterday. At least not in a convincing way.
Okay, Mike, so we move away from the bond futures themselves and go to the more approachable product for most retail traders, which is TLT.
Yeah.
This is near a multi-year low. Like the lows that we've seen since 2006.
Staying long, baby.
Oh, yeah.
What do you do here?
Yeah, TLTs. I like TLT as a Zebra product. So Zebra is just a back ratio. So where you're buying two options in the money and then selling one at the money to remove all the extrinsic value. Basically a synthetic stock position, but for much less capital than actually owning stock. So I'm in the TLT position. I've been in there for a couple of weeks, but I've got the 85, long two of the 85 calls, short one of the 88s in August, 29-day cycle. Paid $500 for it. It's down $200, $300 right now, but it's right there. If you get a move back to 86, 87, it'll be a decent trade. And if it goes higher, it'll be a really nice trade. But yeah, it's trying to get off those lows, but someone in the YouTube chat said, as long as we have uncertainty about Trump firing Powell, bonds will stay heavy, haven't recovered from where they were. Interesting point, but yeah, I'm playing it to the long side. I think it's a low vol product. You can do a lot of different things in there, and you can get cheap delta in there for sure.
Yeah, you mentioned Zebra. People have asked us before. It's zero extrinsic, ZE, and then back ratio, BR, ZEBR.
Yep.
That's where the name comes from. It's basically a near 100 delta replacement strategy, so you can get synthetic stock exposure without having to lay out all the same capital.
Yeah.
Just going a little bit deeper there, Mike, because I know even for me, right? Like I'm like, oh, Zebra. Okay, yeah, okay, got it. A little bit more complicated of an option strategy, but as you point out, it's a way to contain your risk here, given what's going on, and take a shot, because this is maybe the commenter in the chat has a point, right? There is a term premium, Ilya. We shared that chart earlier this week, where since April 2nd, given where notes and bonds have historically traded relative to Fed funds futures, you would expect 10-year notes to be about 40 basis points lower had April 2nd not happened, because the relationship has changed. And so selling puts is different than buying calls. I can tell you I've had dog luck with buying calls in bonds. But for those who have been directionally neutral, the directionally neutral trades have been working fine. It's just being directionally aggressive to the upside's been hurting me, Ilya.
Moreover, by the way, the term premium share in the 10-year yield today increased again. It is now back toward the highs that we set in late May, just 2 basis points off, as a matter of fact. And the term premium, I know this is going to be shocking, has been rising since just about October 2024 and really broke out in November 2024. Before then, from about October 2023 and up into the election, the term premium was actually declining as a share of the 10-year yield. One might say with the election, folks started to want to be paid more for uncertainty risk embedded in duration.
You know, it's a nice place to protect yourself from uncertainty. Silver. Silver's up today. Silver is the most beautiful. Ilya, come on. I got to get you to buy something.
It held in such technical perfection. You look at this and you go, well, you can naysay technical analysis all you want, but I didn't make this price action happen. This isn't an AI-generated chart.
It was Dylan cornering the silver market again.
Is that why he's out today? He's celebrating a successful hunting?
Yeah, with his good, very nice. With his 5-lot SLV call spread. Yeah, that's still a bit in the market.
Yeah.
No, but it's such a clean, it's like 37.70 or so, right? It's give or take 73 here on the high. Yesterday, the low was 75. Today, it was 68.5, I believe. Yeah, 37.68.5. That on the 4-hour chart, former resistance becomes support. We've just seen this recently here in silver not too long ago, where we had the former highs, right, from October and March that more or less, again, once we broke through, resistance becomes support. This thing looks really constructive still. And silver's one of those assets where, like, yeah, we got a little bit of growth tilted data. Are we going to be deficit spending? Absolutely. Why not go back to $40? Mike, do you have any precious metals exposure? Because Ilya, Dylan, and I, Jamal, we've all been jumping in long on these things in some form or fashion.
I'm sitting long gold for the record, and I think it's held up heroically over the past couple of weeks. So I'm happy.
Yeah, I had a bullish position in gold futures in the Q contract, and I just threw on a neutral-ish position in the V contract, 40 days out. Just a wide iron condor there. The short options are at 3,200, 35, 35. So, yeah, we'll see where that ends up. But just wanted to get some kind of neutral, choppy premium in there. But it is interesting to see silver catch up to gold, the gold-silver ratio getting a little better. It feels like the exact same scenario as Bitcoin and Ethereum, where Ethereum is continuing higher while Bitcoin kind of chops at highs. But yeah, definitely involved in gold and silver, and I think they're very similar to TLT. If you're looking for cheap delta, silver, like SLV and GLD, are two products that kind of offer that. Not at the same degree as TLT, since TLT has a lower implied volatility. I guess GLD is very similar in implied volatility, but SLV is a little bit elevated. But $35 stock, you can get pretty cheap delta in there too.
Yeah, we didn't see a big push higher in gold today, but it is worth noting that we do have a nice pull up here as the session goes forward. We bounce off of that 50-day moving average, which we have on several occasions here, early April, right? Again, here in May, and we hold it at the end of June into July. The triangle continues. Mike, I think your approach, honestly, it's been the better approach for the past few months. I've been riding the rails up to the long side on various out-of-the-money calls, and that worked great up until early April. And for the past few months, I've basically just been throwing away money, right? Betting on high convexity trades, 4-to-1, 5-to-1, 6-to-1. And I get a few days where maybe it works out, and then I find myself having to roll the position back basically where I entered. So it hasn't been great for me. But what you pointed out here, going directionally neutral, I couldn't help but just size it up on the chart myself and thinking, what if we hold the May low? What if we hold the April swing high here? What if we were to go out to 70 days and you were to construct a potential trade in this neighborhood, and you could find yourself going $25 wide in a short call spread, this is 40 days, short call spread, short put spread situation, and you can get yourself close to that 60% probability of profit, and you're risking 3 to make 2.
Yeah,
it's not terrible. It's actually a really decent risk to reward, all things considered. And my last checkpoint for this would be how much buying power am I laying out relative to the profit potential here. And I always like when my profit potential exceeds the buying power. So this kind of checks the box for me. Even if I'm going to be directionally bullish, I may want to augment this and add in something that's a little bit neutral in case this thing continues to stall.
Yeah,
it inspired me here.
Yeah, I mean, this has been a really nice trade. This has been one of my favorite trades of the year, is just doing gold futures broke wing butterflies with the intent of, like, if I do it on the call side, for example, where I want it to drift higher slowly, if I throw it on the call side and I'm collecting between $250 and $400, which is typically the setup if you're doing it 20 points wide, 20 by 40, where your long spread is 20 points wide, your credit spread's 40 points wide. If there's a sell-off of any kind and you can remove the risk by turning that 40-point wide credit spread into a 20-point wide and basically legging into a symmetrical butterfly, you can usually do that and lock in a 60 cent or $100 or $150 credit. And then you're ultimately legging into a wide butterfly on the side that you want the product to go to. And if it expires worthless, you keep that small premium. But if it doesn't and it rips towards your spread, you can sell out of it for a greater value. So I've literally had 6 of those in a row. 1, 2, 3. All 6 of them have been profitable between 50 cents and $250. So
very nice.
And that's because even with gold's rally, if you look at a chart of gold, like, yes, it's had these crazy rips, but it's been two-sided to a strong enough degree to where you can remove that risk in those butterflies. So I think I'll keep doing that as long as we see this kind of chop around.
I mean, in effect, where do we find ourselves right now? And this is, where do you want to put on an iron condor? Generally speaking, I like to do it at the midpoint of a trading range. And so when I take a look at the chart right now, I see where our gold prices. These are really ugly colors. We're going to fix all this up. Yellow, yellow, yellow. And goodbye. Okay. So literally the 50% mark of the trading rate, post-Liberation Day high to the post-Liberation Day swing low here. You're at the 50% mark right now. Right? If crude's a good play, Ilya, from the post-Liberation Day high to the Israel-Iran war high, that swing area, okay? We go from here to here, and the 50% mark's right around $66, depending upon what contract you're looking at.
Yep.
Got to play it neutral. Now, the only quip I would have here, and the one thing that's getting at me, the positioning may be a problem. Even with yesterday's news out of the administration, the snip, snap methodology of deciding whether or not we would have Fed Chair Powell continue in his role, we get the pullback from the 50-day, and then we immediately get back up there today, Ilya. And that's because, in my view, this is an exceptionally crowded trade where people are now trying to get out of their short dollar exposure.
Mm-hmm.
And so knowing that short dollar exposure, a leg of that is also long gold exposure. It's one of the reasons why I'm thinking that Mike may be onto something here with playing directionally neutral, and maybe we temper our enthusiasm, curb our enthusiasm. How did I miss that? We curb our enthusiasm about gold's directionality to the upside, maybe play it a little bit more in silver. And if the dollar keeps rallying on this Buy America type of setup, then our gold position may have some problems ahead.
Thankfully, the way that I have my gold position is expressed is through short premium. So I've actually just sold puts, and that's how.
Look at you, fancy.
I have it. That's how I've had it on. Well, no, it's a vertical, not to worry. I'm staying very, very risk defined in these wacky markets.
In fairness, if I was selling puts as opposed to buying calls, all of these trades would have worked out. That's really my issue.
Yeah.
It's the way I structured my opinion.
I looked at vol when I was putting this on, and this is already after an initial roll, and it looked too expensive, and so I did it this other way. And so I'm okay to continue to sit. I've not only used verticals, but I've also given myself a lot more duration this year. So whereas the tasting methodology might call for, let's say, 45 days in, I've been getting closer to 60. Just because I want to reduce my direct exposure to the underlying moves, because these markets have been really, really choppy. I want to give myself a lot of time for things to work, because whereas macro is already a very difficult thing to time, now it's just look at the term premium surging, an even more difficult thing to time. So I'm fine with gold basically idling here. I don't love silver, not because it doesn't look great. It does. No question there. It's just silver has this sensitivity to overall risk sentiment. And if you're going to be bearish, as I am, on overall risk sentiment, gold is your vehicle most likely, and not silver. The dollar rebound is very interesting in this context. I am very long dollar at this point. I've been layering it on essentially for 2.5 weeks now. Started with the pound, added the euro, doubled down on the Aussie just overnight as it made its break, doubled down on the yen last week. So I am very long dollars at this stage, having been very short in the first half of the year. So I've almost completely flipped over the boat. I'm not quite as long as I was short at the end there, but it's getting there. So in my mind, what this becomes isn't so much a buy America thing as it becomes risk aversion, whereby the dollar is again a haven. Because we've gone through the bit, I think, in April where the markets had a genuine concern that, oh my God, we are going to break the US dollar-based global commercial order and surgically extract the dollar and the US Treasury bond out of their bedrock role for modern finance. And then as we force the foundation out, the house can do whatever the house likes. We know what happens to houses when you extract their foundation. So in having kind of settled that concern, April through, let's call it, the end of June, you get back to a dollar, which we can see how it's behaved around the recent spooks in markets. It's gone higher. So I think you're back now to a dollar that's going to be a sort of refuge of last resort if there is a push for de-risking and liquidity. And that's still sort of the world that I'm seeing.
Mike, what themes should we be thinking about for the second half of the year? Is it still AI? I know AI is very much in the news today because of Coldplay, but there has to be other reasons. I would encourage people to listen. When this company IPOs, I will probably be buying some of the shares. Because if they can get to market after surviving this debacle,
it's going to be a meme stock just because of this debacle. That's the best part.
What was it in Knocked Up? Like, oh, you listen to Cole. Okay, never mind. So, is AI still the most prevalent theme in this market, Mike? Jokes about adultery and infidelity aside?
Yes. I mean, it's definitely going to be a focal point for sure. I kind of like the nuclear products that, in theory, should drive the AI movement. Like SMR, you're seeing that rip to highs.
Oklo's doing nice too here the past few days.
Yep. Yeah, I think it's just another way to get involved, but not directly in like a product like Nvidia that's $600 trillion now, 4.02 trillion on its way to 5. But yeah, I think it'll be interesting, and really I think this earnings season will be interesting too, because last earnings season they had the luxury of just saying, "Oh, we can't tell you anything because pending tariffs." But now it's like things are getting more clear. I think we're going to get more. I think the market is expecting more from these companies now that tariffs are getting more clear. So I think we could see some big moves in some single name stocks. But yeah, I think the tech space is obviously thriving. I don't see why that would change unless there's some dramatic shift in the market as a whole, specifically because of the concentration in these tech stocks in the NASDAQ and in S&P 500. I think that is what we saw to a pretty strong degree in April. And, that concentration is not changing. If anything, it's getting more concentrated with people FOMOing into products like NVIDIA and Microsoft and all these other ones that are at all-time highs.
Oh, yeah. I'm going to guess that your theme of the second half of the year is growth, which, in fairness, we did share a stat a few weeks ago, right, about the S&P 500's recovery. This was just the 9th time in history where the index was down by 8% or more at one point in the first half of the year, only to close the first half of the year in the green. 6 of the previous 8 occasions saw the S&P 500 close the second half of the year even higher, but the only 2 occurrences where it did not, 1957 and 1990, were years in which recession came out of it. So we had said back a few weeks ago, the game that we're playing now as bulls is basically, are we avoiding recession? And so you'd have to forgive me then for thinking the retail sales data today is better than expected on all accounts, the inflation adjustment aside. Recession's a little bit less likely at the margin. That should be good news for stocks because that's the game we outlined a few weeks back.
That's actually not what I see at all. I see that
of course not.
No, and neither does the Atlanta Fed, because they revised their consumption component in second quarter GDP down, not up.
Which is a story, by the way, we wanted to get to earlier. Sorry to interrupt you, but this is a long-standing story of what's been going on with retail sales the past few years, where part of the reason why the Atlanta Fed revises things down is because they make their inflation adjustment. And if you take a look at this, comes from Greg Dachau over at EY Parthenon, their chief economist. If you were to adjust retail sales going back to basically the start of 2021, they're flat in terms of volume. The reason why they're higher is because of inflation. And this is one of the quips that we see with the actual spending data. Today's a nominal release, so it doesn't really tell you what's been going on if there's been a big push higher in prices behind it. Because, again, at the end of the day, P times Q equals GDP. So if prices go up and quantity of goods stays the same, you've actually have a bigger GDP number, but you're not actually moving more product. I digress, Ilya. Your point?
Well, that's exactly it. So what this chart is telling us is basically that retail sales has been soggy since basically the beginning of the year. And of course, we already had the first quarter GDP number. It was negative for reasons completely unrelated to retail sales or to consumption in general. Obviously, the huge 40% swing in imports was a very anomaly-like development. So was the surge in the investment component because all of those imports went into inventory. That's now cushioning consumers from costs, as are wholesalers that are eating into margins to cushion consumers from higher costs. We saw that in the PPI report for the third consecutive month yesterday. But nevertheless, you take all of that noise off the table, because that's just statistical anomaly, whatever. We had the weakest consumption as a component of GDP in the first quarter since the second quarter of 2023. This retail sales report, nominally, forget inflation for 1 second, because that actually makes my point stronger and makes this look even worse. Let's look at the nominal side of things, because the rising inflation in June flatters this somewhat. So let's take that impact. Even still, retail sales on net fell by about 3.3% over the course of the second quarter, because the declines in May and in April far outstrip this bounce in June. But of course, the bounce in June is forceful enough because motor vehicles are such a large component, and that's where the recovery occurs, to flatter the headline number, one headline number. If consumption, which is 69% of the GDP total, is getting weaker into the second quarter, the risk of recession isn't lower, it's higher. Now, are we going to get a recession confirmed in second quarter GDP numbers? Almost certainly not for any kind of underlying consumption reasons. If anything, we'll have more chop around the tariffs, but the negative number in the first quarter wasn't a real negative number because of all this weirdness. But that's
how many recessions have started with a 40% surge in imports?
This is a weird thing, right? Because this surge in imports is not a reflection of consumer demand. It's a reflection of companies trying to pull orders forward because they don't want to pay tariff rates later. There's still this is why you got a massive parallel surge in inventories. It's not like this 40% jump in imports, like, oh my God, everybody's buying stuff. Import more. No. It all went into warehouses. Waiting. So that's going to smooth out how much goods inflation consumers see. It's not going to get rid of it. And when we look at what wholesalers have been doing, they are already fighting a losing battle because they continue for 3 consecutive months now to eat the input costs. And yet, in June, the goods inflation numbers in CPI started to creep up. It's a losing battle. They can only eat margins for so long. They will pass it on.
Probably fourth quarter.
They're not going to take themselves out of business for the sake of not raising prices on consumers, because of course they're not doing that so as to protect the demand. But
they're talking about this in their earnings. A bunch of companies are saying how they're working on supply chain management right now, and they'll worry about revenue management tactics later on, which is basically saying we're going to figure out ways to get deals. We're going to start cutting promos, and hopefully when we raise prices, we can make it up on volume.
Yeah.
I mean, that's the playbook that Samuel Rhines over, I think it's Employ America, has a really good article about how businesses are going to navigate this environment moving forward. Mike, we got 5 minutes left here on the day and the week. Netflix's earnings are helping propel the Nasdaq here higher after hours, 23,251. We're not the exact high, but it's pretty darn close. This would be a high 4-hour close of all time. Do you care about seasonality here and the market that tends to get stuck in the second half of July? Does that matter to you whatsoever?
Not necessarily. I think there's always interesting data points when you look at long-term analyses for certain months or certain quarters, but I think right now there's a lot of pending things. I mean, a lot of stuff is potentially priced in, like the Bitcoin rally we saw up to 120K. I think that was pricing in what we're seeing today with the passing of stablecoin legislation, and this week is crypto week, blah, blah, blah. So, I think the market always knows first, and I like to listen to what the market is telling me versus my own assumption. But again, I think if we stay in this 15, 16 VIX, how are we going to drop from 6,300 to sub 6,000? I don't think it's going to happen. I think we would need to see the VIX pop back to 20, 25, 30 before we get down to those levels. And that obviously makes sense, but we need that kind of volatility pop before we see substantial moves to the downside. And if we don't get it, I think we'll still see chop. Don't get me wrong. I think we'll still see days where we're down 100 points, 150 points. But I think the trend is up and to the right, for better or worse.
Up and to the right until it's not.
Until it's not.
Yeah, yes. Exactly.
And also, Ilya, the screen was from Ryan
for yourself
over at Carson Research. Oh, no, go ahead. Sorry to interrupt you, Mike. Have the floor.
Speak for yourself, Ilya. I bought 100 Lulu joggers, so it is not company's front-loading inventory. It is my demand.
Nice.
All kidding aside, but yeah, they're doing that.
I'm more of a Viore person. I'm finding those to be.
They're great.
It's all about Mac Weldon, gentlemen.
Me and Nick are both Viore boys.
Excellent. Good for you. And see, that's why we get along. We understand the sports betting and the attire.
Yeah.
All right. Ridiculous stories to close the week. What's the most ridiculous thing that we've heard in the market this week so far? I don't know if there's a good corporate story out there, if there's anything good about AI, if there's anything good about the Fed.
Gotta be the NVIDIA story. Come on now.
NVIDIA now being worth more than the Japanese stock market.
NVIDIA being allowed, NVIDIA having restrictions on H2O chip sales to China lowered because we're in a trade war, everybody.
I think it's the White House pump it up meme. Like that's
that's a good one too.
The most wild thing I've seen.
I mean, isn't that? I think that's kind of validating though, in the sense that, I mean, Ilya, you're here every day with me. I've had a very stupid point of view that they're just going to pump it. And, you know, you drop a meme of American Eagles making it rain Benjis. I don't know. It kind of feels like we were right.
Yeah.
It's getting ridiculous. Yeah. It's getting so ridiculous. But you know what? We're here for the ride. Sticking with the same things. I'm not in tomorrow because we're celebrating our 36th turn around the sun. But leaning along the NASDAQ, 23,350 calls, 23,350, 500 call spreads with an expiration of Monday. So let's make it happen. Just 100 points. That's all I want. Just 100 points between friends. Likewise, though, still along the S&P 500, like 59.75, 6,000 put spread. That's dated for the last week of August, because I think we are, Mike, we're in this, let's blow off the top, get a little crazy. Bonk is up 18% pre-market today. You know, when the meme coins like that and all the, what do they call them, the shitcoins, when the shitcoins start going, that's when. Yeah, so the signs of a peak are getting close and we're near a seasonal top. Volatility tends to bottom out in the third week of July, which we have now entered. So buyers beware. But I suppose with that, overtime is now out of time for this Thursday and this week. We'll be back next Monday, same time, same place, 4 p.m. Eastern, 3 Central, as always, right after last call. So for Ilya Spivak in San Francisco, Mike Butler in Chicago, I've been Chris Vecchio in New York. Good luck trading. After this, brief break, and then Ilya's back with macro money. See you there.
See you there, everybody. U.S. retail sales data seemed to surprise higher, but for some strange reason, we'll get into what it was in just a moment, bond markets and the Fed didn't think that this was necessarily good news. So what does this mean going forward, and how does this set us up for the market's perception of the U.S. economy as we get into the second half of the year and start to think more acutely about economic growth? That's what we're going to cover here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And the markets, to be sure, certainly liked today's retail sales report. And indeed, that seemed to be the cue for stocks to launch higher. But nevertheless, one does have to ask the question and look under the surface, how is the U.S. economy actually doing? And those details are perhaps not quite as encouraging as the markets thought they were. Here's the performance that we see, and here is around where we get that retail sales report right here. We can see once we get it, the S&P 500, the Dow, they inch higher. It's a similar story for what we got in the Russell. So the markets did like this data, and at the headline at least, it certainly seems to make sense why. Overall retail sales up 0.6% compared with a 0.1% consensus. And indeed, as you look down kind of the various permutations of this data, you see that the control group better, even if you exclude autos here, it's a little bit better, although not by much. The gap narrows to just 0.2% from this gap here. So autos obviously an important consideration here, but nevertheless, the numbers look in all better. In fact, this increase in the year-on-year reading up to 3.9% was the first uptick in 4 months for the year-on-year rate. So on the face of it, these are certainly encouraging until you look just a peek under the surface. Here's the breakdown by category, and you can see here's retail sales. Here you can see they fell over the preceding 2 months, down 0.1% and 0.9%. Here's the 0.6% increase. And the thing that really stands out immediately is this motor vehicle component. And to some extent also building materials and equipment, which is why it's not just a story of one category per se. It's why even when you take autos out of the equation, you still get this little increase, although it's much more modest. But this is really the main story because motor vehicles are between 20 and 22% of the retail sales total, which of course makes sense. Cars are one of the most expensive things that retail buys. So, not surprisingly, it's a very large part of the tally here when you take the amount of money spent against units moved. So, what you're looking at then is a situation where, to be sure, this very potent increase of 1.2% in June is an understandable way to power retail sales to better than expected results. To some extent, the 0.9% rise in building materials is likewise a standout, but it still is a smaller component of the total. It's really this motor vehicle bit that is the driver, given how important this is for the headline tally. But consider that this comes after 2 months of significant losses. A 0.7% decline in April and an eye-watering 3.8% decline in May. And when you add all that up together, what you end up with is retail sales, at least in motor vehicles terms, that are on net down about 3.3% in the second half of the year. Or in the second quarter, rather. In other words, the 1.2% rise is nowhere near enough to offset these losses earlier in the second quarter, and that, of course, is echoed, albeit with some diluting in the overall numbers. So retail sales on the whole actually fell over the course of April, May, and June. And that, of course, sets up an ominous sort of a backdrop for what GDP data will do, because already in the first quarter, if we discount all of these shenanigans with front-running the tariffs, this 40-ish% swing in imports and the stuffing of all those imports into inventories, which then gives us this surge in the investment component of GDP. It's how you end up with a nominally negative GDP number in the first quarter. So take all this noise and let's chuck it. Because as a lasting thing, it's obviously not a factor. This is front running of tariffs that have since arrived. And moreover, when you take these components and you consider how much of GDP they account for, but for these wild swings in the high double digits, which are very abnormal, all these components add up to a pittance in the overall calculus of GDP. By far the biggest component is household consumption. And what we saw was that in the first quarter, it was the weakest since back here, going back almost 2 years. And we end up with a story now, given this guidance from retail sales, that seemingly points to another weak set of consumer numbers in the second quarter, which of course, given that this accounts for such a dominant part of GDP, 68, 69%, depending on the quarter, is telling us that the underlying economy is actually slowing and slowing considerably. And perhaps this is why, in the wake of these retail sales numbers, Fed policy expectations actually moved to a more dovish setting, despite these ostensibly better than expected numbers. We end up with a little bit of a trim on this year's rate cut outlook. We're to 38 basis points now, so we're not quite sure we're going to get a second cut. Markets are now fully baked in for a single 25 basis point cut. They're 13 basis points in the direction of a second one, so that's narrowly better than even at 52%, but only just so. But the real disparity is for next year, where the markets are growing increasingly dovish, including today, which is how you get this net more dovish move in the sum for the outlook between now and the end of 2026. For next year, we've moved out to 73 basis points, which essentially means we've all but completely discounted 3 cuts next year, whereas the Fed only sees 1. And so the markets are clearly signaling here that what this retail sales data means is that in a optics sort of way, this probably means that there's maybe a little bit less scope for rate cuts this year. But this does not change the trajectory of economic growth in a more positive direction. It just delays rate cuts and pushes them downwind. Because indeed, the weakening of the economy continues all the same and is in fact made more apparent by this data. Tellingly, in this context, the Atlanta Fed's GDP Now estimate of second quarter GDP numbers that takes in incoming economic data and then feeds them into this model that's updated sometimes daily, as long as we have data to look at that is relevant. We now see it was revised lower today, not higher, on the basis of this data. And that's largely, if you actually see what the Atlanta Fed flagged as the reason for the adjustment. And here a quote is perhaps most appropriate. The Atlanta Fed very directly says that what they did was downgrade personal consumption expenditure expectations. So the markets looked at this, as did Fed economists, and collectively came to the conclusion that in the wake of these apparently better than expected retail sales numbers, the consumption piece for the second quarter looks worse, not better. With that, we get another view of where consumers' heads are at, going now into the second half of the year, with the last bit of notable event risk for the week, the University of Michigan Consumer Confidence Survey. And here you can see we saw a very spirited rebound off these COVID equivalent lows. These, of course, were the post-COVID bottoms in sentiment here, and not surprisingly, sentiment was declining as inflation expectations were rising as a consequence of the pandemic's many disruptions. And once inflation started to fall, once the Fed really started to lean into rate hikes, you can see this is, of course, the beginning of 2022 right here, where the Fed really starts to hike. Once that starts to have an effect and inflation expectations decline, sentiment improves. As you get the advent of tariffs at the beginning of this year, inflation expectations surge and have in fact surpassed at one point, the COVID peak, sentiment craters. Fast forward to the June survey, and the decline in inflation expectations from 6.6 to 5%, looking 1 year forward in these numbers, that gives you a potent jump in sentiment. As we look ahead, we can see the overall index is expected to nudge up just a touch, but expectations looking forward 6 months or so, as well as the assessment of current conditions, a little bit weaker in the forecasts. And perhaps that makes a bit of sense, warns that actually the headline figure might disappoint. And that takes us back to these inflation expectations as a driver of sentiment. Now, we just saw earlier this week that although the overall CPI report looked encouragingly normal at first blush, and the increase in headline inflation matched expectations pretty much exactly, 2.7% increase in the headline from 2.4. The thrust here came not from services, where inflation already is the most dominant, and that's not surprising. Services is the biggest sector in the economy, but from goods, suggesting that the impact of tariffs is starting to appear. In fact, here's the change in monthly contributions to year-on-year figures. We can see the overall headline figure rose by 0.3 percentage points. That's from 2.4 to 2.7. But the thrust here is 4 times larger on the goods side than it was on the service side. If we actually look at the momentum of prices rather than just their levels. When we then got the PPI report, that seemed to continue. The goods component in PPI saw its first large increase in quite a while, and the largest since back here, January. So this is now a very sort of straightforward appearance for inflation linked to tariffs. We can obviously see that goods inflation has been basically non-existent going back for 2 years until this. Moreover, if we look deeper into the price dynamics here, we find that at the very beginning of the U.S. supply chain, at the intermediate demand level, before goods essentially go from who initially begins to have them at the wholesale level, then moves them on to final distributors that then put it out in stores and, of course, make it a retail-facing item. At the very beginning of the U.S. supply chain, margins got absolutely smoked 3 months ago. In fact, this is the biggest decline in wholesalers' margins since back here in 2013, the worst in 12 years. And for the subsequent 2 months, those margins didn't exactly keep pace, but they continued to deteriorate, suggesting that wholesalers are eating inflation costs, ostensibly from higher input costs around these tariffs, without passing them on to consumers. This is, of course, or even to final demand distributors, so wholesalers downwind along the supply chain. And in fact, as we look at corporate earnings reports, we see companies attesting as much. So with all of this in the inflation data, there seems to be a meaningful risk that consumers have noticed that the price of stuff seems to be heading higher, and that the thrust there seems to be significant and more notable than it's been in quite a long time. Now, if this feeds into these one-year inflation expectations and we get a nudge up here, given how this has been the driver of sentiment for the better part of 4 years, one would expect that sentiment would then deteriorate and give us a disappointing outcome, which would then, of course, make the second quarter story that much more ominous. If consumption is as weak as it appears in the first quarter, and it looks like it's on a pathway in the same direction in the second, if not worse, then all of the growth concerns on display in the first half of the year, they have the capacity to become still more acute. Now, you might say, what growth concerns? Stock markets hit a record high in the first half of the year, and that's certainly the case. However, as we keep going back to here over the past several days, notice that in the first half of the year, stocks, whether you look at the S&P or the NASDAQ, rose only a touch more than their normal 6-month average, but those gains were absolutely dwarfed by a dramatic US dollar sell-off. The dollar fell 9% against the yen, almost 40% against the euro, over 25% against gold. And so, if we consider stock markets up 5.4 or 7.9% up, it's important to remember they're up in dollar terms. Factor out the influence of the weakening dollar on inflating these asset values and express them in any other major currency, and you end up with a loss for U.S. equities in the first half of the year. Meanwhile, for all the fire and fury in the Middle East, crude oil fell 9.2%, and the front end of the curve continued to price in rate cuts. Front-end yields fell. And whatever happened in crude oil clearly seemed to suggest that the markets are more concerned with demand destruction than they are with supply being disrupted. And so, again, just a small look under the surface, and we end up with markets in their price action telling us we're not concerned about something cataclysmic. In fact, this whole Sell America dynamic is obviously not something that stands out, because clearly the decline in 10-year yields suggests that investors are perfectly happy to lend to the U.S. sovereign at favorable rates, because their faith and their confidence in the faith and credit of the U.S. government is unshaken, despite recent events. But that, in fact, what they're still seeing is rate cuts and demand destruction. And, of course, against that backdrop, a weaker U.S. dollar makes quite a bit of sense. That dollar weakness then is not about jettisoning U.S. assets, as the 10-year would surely attest. It is about getting ready for an easing cycle against the backdrop of something that starts to smell like a recession. And so, with that in mind, if you then get aggravation of these dynamics as you head into these numbers, and if they disappoint because inflation expectations here tick higher, the story for the second quarter starts to look a lot less resilient than perhaps the nominal dollar-based equity market levels and valuations would suggest. With that, we have today's episode of Macro Money. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go from there. we are going to be off here next week, but Macro Money will be back the week after. In the meantime, I'll be surely still commenting because I can't help myself on the platform formerly known as Twitter and on Blue Sky at Ilya Spivak. If you're watching this on YouTube, like and subscribe. In the meantime, happy trading.